When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
We are all unique. Without diversity, life would be excruciatingly dull. It's something worth celebrating. It's something that makes us stronger as communities, as businesses, and as individuals.
I see the benefits at Bloomberg on a daily basis. It's beyond flying that rainbow flag. It's about taking the discussions out into the world and making a genuine difference.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Good morning, everyone. Bloomberg Surveillance, thank you for being with us. So we'll have complete coverage of Jerome Powell. What time is that, Lisa? I have no clue.
Well,
10
their
a.m.?
prepared comments get released at 9:30 a.m., and then at 10 a.m. the testimony begins. Aren't you really sorry you asked?
I'm really glad somebody's up to speed on this, but these are important comments, and of course we'll address the emotions out there. I would suggest, Lisa, we touched on this yesterday. Yesterday was sort of a nudgy day. Today there's a little more clarity here. Futures negative 51. But Lisa, yesterday we touched on this, the emotion over a longer weekend of the impact of inflation on everybody. It's tangible.
It's tangible, and then people start to ask, has it been priced in? And yesterday there was actually a sigh of relief in markets, nudgy to the upside. And today it's not nudgy, it's just to the downside as people start to price in what Bill Dudley called the inevitability of recession in the next year to 18 months.
Here is the important conversation of the day with lots of years of experience. Margie Patel at Pioneer for years, and now Allspring Global Investments, is definitive on high yield and has been brilliant on shifting to equities amid the carnage. Margie, you and I have never seen a bear market in bonds like this. The Bloomberg Total Return of High Yield Series is down 13%. I'm going to call it 3 years of coupon. I'll let you correct me on that. What do you do? Forget about the genius of Margie Patel and equities. What do you do if you're in bonds to recover, or the emotion of trying to catch up, clipping coupons?
I think all you do at this point, because of the huge correction we've had in bonds, high yield and investment grade and treasuries, is just wait it out. At least you're getting the coupon income, and we have the promise down the road, because virtually the whole bond universe is now trading at a discount. We could have that little capital appreciation back to par if the Fed ever decides to reverse their very perilous course they're taking here.
Okay, so this is really important. You're on the edge of Daniel Fuss over at Loomis Sales here. You're looking right now, is bonds, is a clip the coupon, and you're going to get a gain out there at some point.
Well, that's right, especially in high yield, because there you've had a huge correction, really not because of credit spreads getting wider, people worried about bankruptcies, but just following treasuries. So bond prices have gone from, say, 103 for the average high yield bond to about 87 cents on the dollar. So that makes a lot more return, say 7 to 9% for decent companies with positive earnings. That's not a bad rate of return.
Margie, have stocks actually acted as the hedge you thought they would?
Well, no, I expected stocks would go down, and of course we see the weaker links, the most vulnerable, have gone down the most. And the thing is, even if you don't own those weak links, the SPACs, the negative cash flow, small companies that were able to come to the market, that still can roll over to the other market and affect everybody's risk budget pretty much. And I think that's what we're seeing, is that just roll through to other sectors, people being fearful about what's going to happen to the economy, besides the areas that are weak.
Well, Margie, to that point, we just had summer begin. This is sort of a reset moment where people take a look at the 20-plus plunge in the S&P and the massive disruption in bond markets. And PIMCO's view is, wait a second, bonds suddenly hold value in a way that they hadn't in decades. And take a look at how much value they hold versus stocks. Are you kind of starting to lean toward that type of assessment?
Well, I think in high yield, when you look at, as I said, a yield of 7, 8, 9% with 10 or 12% discount from face value, if you think equities might do, say, mid-single digit to low double digit over the next, say, 12 to 18 months, that makes high yield bonds look pretty competitive, assuming we don't have a big jump in defaults, which are about 1% now. It doesn't look like we will, but we haven't seen the Fed complete their Fed tightening, so it's not really clear how much this will go over into the real economy and hurt financial results.
But Margie, because it's Interrupt Wednesday or whatever Tom called it, just to follow on to that, do you not see value in higher rated bonds? I mean, is this still a moment where stocks offer a better hedge even after all the losses? And I don't want to say contagion, but the influence from the SPACs and other over-leveraged areas of equities?
Well, I think so, because the yield is simply a lot higher, the gross yield, and also because the yield is, say, 400, 500, 600 basis points more than treasuries. They aren't as sensitive. Investment-grade bonds are very sensitive to treasuries. They trade at a pretty small yield premium. So it's really more a bet on what treasury yields are going to do, whereas high yield, you're getting something that looks pretty much like an equity-like return, if only from the coupon income. So that looks like a pretty good deal if you're a little bit nervous and you don't want to wait out what we may see further bottoming in the equity markets.
Okay, well, Margie, you mentioned what treasury yields are going to do. There has been a relationship for some time now where when you see yields go up, it puts pressure on equities, because especially those of higher multiples that command higher multiples. Now we're seeing yields coming in, but the reason why is growth concerns. So can that be a supportive factor for the equity market, or if the concern is around recession, that just means more downside for equities?
Well, I think so far in this equity correction, what we've seen mostly is a erosion in the price-earnings ratio from, call it, say, 21 times earnings to maybe about, say, 16 times earnings going forward, rather than people saying, oh, earnings are going low. So what I think I'm looking for as we start to see the quarter results, which will be in a few weeks, is are companies beginning to talk about lower earnings, which could cause not only that PE compression, but you may see stocks go down just on earnings expectation. But clearly you have a much bigger cushion with the PEs having gone down so much in the better parts of the market.
Well, to that point, I'm looking at the NASDAQ 100, for an example, which traded at a multiple of about 30 at the end of last year, now trading down around 20 times. Where has enough value been created, or valuations come in enough that you actually think it is safe to find an entry point here?
I think this is a pretty attractive level, because the average stock is down 15, 20, maybe 30% in NASDAQ. The price-earnings ratios are more reasonable, more average, looking over a longer time period. And the question really is, what companies will be able to maintain their earnings and not have sharp earnings declines from here? But still, I think with so much speculative money that's really gotten hurt so far this year, that can roll over into the better quality names, too.
Margie, a rude question. Is 60-40 dead? 60% equities, 40% bonds? You fought against that your whole life. Is it finally dead?
I think it is, because I think what we've had since the financial crisis a decade ago and now is the Fed's discovered that they can control interest rates, and they seem to like to do that. And I don't think they're ever going to want to let interest rates float where the market would like to see. So I think that says interest rates will be lower regardless of inflation than anything we've seen in the past X decades.
Margie Patel, thank you so much. Greatly appreciate it. Allspring Global Investments. There's lots going on here. The VIX out of stick, 31.23, and Of course, we're watching yen here. I got to get it on my screen. 136.19, pretty much unched on yen, but not unched is Mr. Savings at Deutsche Bank. One of our interns, Lisa here, sends in a note, hey, stupid, you've got to pay attention to what Savings saying at Deutsche Bank. Oh, Lisa. What is Savings saying at Deutsche Bank?
Man, you know how to flatter me on a Wednesday, Interrupt Wednesday. I'm looking at his comments about the likelihood of recession. He says it's about a 50% likelihood that we get a global recession. He also talks about how the inflation that we're seeing is a threat to democracy. They see this as permanent inflation that needs to be countered more dramatically. However, he is confident that there is going to be some sort of method to combat this. What I find also interesting is he talks about a banking union in Europe and mergers and the idea of consolidation in order to weather this storm. We're looking at a new landscape where you've got a growing number of executives and policymakers saying that there is a greater than 50% chance of a global recession. And Tom, that is what you're feeling in the tape today, and that is what you're feeling people game out.
For our American audience, and I met with him informally in Davos. I've never formally interviewed Mr. Saving, but Lisa, the only equivalent I can think of in American banking is Brian Moynihan. He's completely steeped in the consumer and retail experience. And this headline, "This is not at all temporary inflation," is the theme of the next 90 days. Is it?
Well, Christian Saving has an extra leg up also on Brian Moynihan in that he took Deutsche Bank from what was left for dead for some people, expecting it to be assumed by another banking entity in the European Union, and actually made it viable in a way that people hadn't imagined for a long time. He was sort of heralded as bringing this sort of new dawn to the bank. Whether that's in question now is left up in the air given some of the existential threats to just the entire economy. However, looking at how these main executives are gaming out recession in the U.S. and Europe by the second half of 2023, Tom, that's a game changer, and it's the reason why yesterday we were talking about the new discussion is how deep the recession will be. Will it be shallow? Will it be steeper? And how do we climb out?
I mean, Kaylee, it's real simple here. There's a headline buried in like 40 headlines on the Bloomberg. Mr. Saving taking second look at ESG after greenwash allegations. You follow this tangentially, Kaylee, off the dynamic show Crypto. Folks, if you missed that yesterday, you can see it on 47 digital platforms. But Kaylee, I mean, how dead is ESG right now?
I think that's the question. The problem with ESG has always been, Tom, how unclear the parameters of it are, and the concept of greenwashing, saying things are green when really they aren't, or you're just
using
Is that what that
means? I don't even
offsets.
know. What does greenwash mean? I don't know.
It's the idea that you aren't actually making as much of a difference as you say that you are. And for sustainable investing, until you get more firm metrics, it's very muddy. And of course, this is a particular problem at DWS. We saw those raids several weeks ago, which is what Saving is alluding to here. But I would note that it's not just about the E in SG. It's not just about green investing, for example. It is also social and governance. And remember when we saw Tesla kicked out of the S&P ESG index, Tom, even though it's an EV company? The issue there was not with the green. It was with social and governance. And Elon Musk, we know, took a bit of an issue with that.
We thank Mr. Musk for his conversation with John Micklethwaite yesterday at the Qatar Economic Forum. Futures at negative 55, down futures negative 382. The VIX 31.26. It's a toxic brew of angst this morning. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Bloomberg's learned that President Biden will call on Congress to enact a gasoline tax holiday. The president's expected to make a statement today. Average gasoline prices are around $5 a gallon in the U.S., and they typically rise in the summer. Federal taxes are 18.4 cents a gallon. It's not clear how long the president wants the tax to be paused. Boeing CEO sees supply chain issues lasting until the end of next year. David Cohen also told Bloomberg's Guy Johnson that's not the industry's only problem.
We have a very large, sophisticated, and somewhat fragile supply chain behind the airplane manufacturers. And just as fragile, it turns out, are the operators themselves, the airlines, and the ability to staff up with pilots, the ability to staff up the ground crews, maintenance crews, etc.
He was interviewed at the Qatar Economic Forum in Doha. Richmond Fed President Thomas Barkin is calling on the central bank to raise interest rates as fast as it can, as long as it doesn't cause undue harm to markets or the economy. In Barkin's words, go as fast as you can without breaking anything. Fed policymakers raised their benchmark rate by 75 basis points earlier this month. That was the biggest increase since 1994. In Afghanistan, at least 920 people have been killed and hundreds more injured in a powerful earthquake. The magnitude 6.1 quake struck the southeastern part of the country overnight. The government has sent helicopters and rescue teams. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
It's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
are seeing signs that tighter financial conditions are likely weighing on economic activity already. We think that these signs are likely to intensify. Yeah. We're getting the sense that housing is beginning to feel the pinch of tighter financial conditions.
Pusha Sriram of Barclays yesterday piercing on the housing economy. We do this with the median price in the United States ticking over $400,000. It's like Dow 10,000. Don't tell John Farrow, but I can equate it to Dow 10,000. Just 400,000 is just a huge emotional number for those tracking housing. In the last 20 years in the United States, the median price was up in the last 10 years back, 1992-ish, I think, up 4%. Per year, and in the nearest 10 years, rather, it's up 8% per year. So there's been a real adjustment there from a 4% per year gain to an 8% year gain. Enda Curran in Hong Kong and Bloomberg Chief Asia Economics has done a global study of your biggest headache, which is rent and housing prices, and it is absolutely definitive. And I know Lisa wants to jump in here, but let me ask one question. How bad is it?
It's pretty worrying, Tom, because what we're seeing now is potentially a reversal of those huge gains that we saw during the pandemic when a lot of new buyers came into the market on very low borrowing costs. As you know, interest rates were so low. That's now being unwound due to inflation. Central banks bringing up their interest rates. That's bound to hurt households paying back those mortgages now. To be clear, we're not yet at 2008 style territory, but it certainly is a significant potential headwind for an already slowing global economy.
And I think it's an important characterization. This is not necessarily going to be the bottom falling out from underneath the housing market, as you say, because there isn't the same type of leverage. There isn't the same sort of shadow banking system fueling the growth of houses purely for the flipping of them. At the same time, can you give us a sense of why it is so much more painful in an economic downturn when the housing market does not cooperate and cannot necessarily be fueled by the same type of monetary policy that's already been used?
Yep, you're absolutely right, Lisa. As you mentioned, there are buffers, banks are in better condition, household savings are in good order, and of course, labour markets around the world are strong. Nonetheless, if we do have, and we are in fact in the middle of a synchronized monetary policy tightening cycle, the likes of which we haven't seen for some decades, that means there's going to be an inevitable impact on mortgage costs and on the prices of houses. That will flow through to consumers by denting their household wealth. It will hurt consumer confidence. It will flow through to activity around construction and sales. And of course, as we know, real estate and residential houses are big multipliers in any economy. They're at the core of economic activity. And if we see a slowdown in house prices and housing activity, even without a crash per se, like you're saying, that's going to come on top of everything else that's going on, which is a pretty subdued consumer due to inflation, the energy and food crisis, the ongoing supply chain problems. So I think it's probably the last thing that the global policy maker set needs right now is a housing crisis on top of everything else.
But in theory, Enda, couldn't this also be helpful in that once it feeds through to sentiment and it starts to lead to more demand destruction, it actually helps with the inflation problem?
Well, exactly right. Again, this is textbook, okay? The idea is central banks do, of course, want activity to slow down. And when you have slower activity, the thinking is that it will slow down inflation. You heard the Fed official speaking earlier about how he wants the Fed to go fast without breaking things. And that's the whole crux of this. Plenty of first-time home buyers around the world would welcome a cooling of house prices, but can central banks pull that off? Can they cool house prices and cool inflation without sending their economies and broader markets into a slump? And Bloomberg Economics have done the hard numbers on this, and they're pointing to some economies that are vulnerable, and that they include the US and the likes of Canada and New Zealand's in there as well. Some central banks are already warning that they do see potential for a material correction in their house prices as interest rates go up. So it's going to be something of a pretty tricky balancing act to have house prices coming off at a nice stable pace without, of course, hurting the whole broader consumer and recovery story.
Well, you mentioned some of the specific countries, New Zealand, Canada, the UK is in there as well as the Czech Republic and Hungary. Which is the most vulnerable looks the most vulnerable to something more systemic emanating from housing?
Well, on the Bloomberg economic rankings, probably New Zealand, that's a standout, but each country has their own vulnerabilities. They have their own pockets of vulnerability in different areas. And of course, a lot will depend on how aggressive this interest rate hiking cycle ultimately proves to be. If we reach a point in the not too distant future whereby it's clear inflation has peaked and in fact the economic damage is to the point that central banks sort of ease up on the rate hiking, well then obviously that will take pressure off the housing market. But if we go into the end of the year with rate hikes going at the pace that they are now, that's going to have, the expectation is that will have a material impact, because remember there's a lag effect in monetary policy. It takes some months before it really does hit consumers' pockets.
And what did Finland get right?
Well, I guess we're going to find out if they are getting things right or not, Tom. I mean, we're early stages in this cycle at the moment. I think that's what a lot of people are saying. We have to give this time. I think 6 months from now, 1 year from now, it will be clear that when the tide goes out, just which housing markets and which banking sectors are in good order. And that's the feedback I've gotten from a lot of people today. It's that we're still early in all of this.
And to thank you so much, early with research from Bloomberg Economics, so it's absolutely definitive on global housing. It's, you know, Lisa, to me, it's almost like Jonathan Miller and Miller Samuel taking Manhattan and distilling, or New York City and distilling out 5 boroughs. Enda and his team do the same thing, but across many nations.
I want to dive into one point that he mentioned,
Please.
and Kaylee was mentioning this as well, that eventually this will bring down inflation, because eventually lower housing prices will translate into lower rents, and that will be a big decompression for some of the inflation. The concern is right now that there is so little housing versus the demand that even if you get housing price declines, rents are still climbing at a record pace, unprecedented pace. In some areas, 40% year over year. I'm thinking of Miami, for example. If you take a look at some of the rents in April, given the fact that there is not the supply, and given the fact that people who would have otherwise been buyers can no longer do so at a mortgage rate of 6%, rents are only poised to climb further in the next 6 months. This is a huge concern to so many economists, seeing pressure on the CPI, even with housing prices getting a little cooler.
You know, we talk in our real Bloomberg world about idiosyncratic, like Turkish lira maybe is idiosyncratic, but Kaylee, I would suggest region to region, almost city and village in America, this is highly idiosyncratic.
Yeah, that's definitely true. I mean, you talk about the 5 boroughs here in New York, Tom. I'm a resident of a new borough, Brooklyn, because it has gotten so expensive in Manhattan, and frankly, Brooklyn isn't much cheaper. Matt Miller, our colleague, recently bought a house in Westchester, and Tom, he was like, you should move up there, get a yard for the dog, come join me a little north of the city. I can't afford that mortgage. It is, and it speaks to the catch-22 people are facing when you have higher mortgage rates, which limits your ability to buy a home, and rents are also high.
Well,
speaks to the problem.
Yeah, I think the mortgage rate, I haven't looked this morning, like Julia Coronado, Lisa, talking up 6%, boom, we're there in a matter of days.
It's actually exceeding 6%. So this is a reason why people are not able to get the same kinds of mortgages. They're not getting approved, and then they decide not to buy, or they lower the price, and then they rent.
We will follow this on Bloomberg Surveillance, folks. We understand, you know, it's not the market, it's not the yen, it's not bond dynamics. Well, I don't care about them. Lisa and Farrell care about them. I don't, you know. The 10-year yield's 3.22%. There, that's my bond coverage.
You're right there, Gil.
That's my bond coverage for the day. Which hotel's Farrow and in Capri? It's Le Corbusier.
It's one word for it.
This is Bloomberg.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
No central bank wants to engineer a recession.
A lot of countries right now are playing catch up when it comes to getting inflation under control.
I think the Fed's going to have to be aggressive.
I do think recession risks are going up each time the Fed moves, and the Fed moves very aggressively.
At this point, I don't think a recession is yet inevitable.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Thank you for being with us. We're back on track in this hour. Lots of distractions in the last hour. It's about inflation. It's about recession. Lisa, William Dudley says it's about a hard landing.
In the next 12 to 18 months, and the specificity is what really struck me about the column that was published this morning, talking about how it is now inevitable that we are going to get a recession in such a short time frame, building on what other people have been saying, that there's a growing chance of some sort of downturn. Now the question is, Tom, how steep it will be and whether it's accurately priced into markets.
And this is the gauging of the many different types of recession. If you lived them, folks, we don't need a history lesson here, but each one of them is different. And Lisa, you were correct to mention this distinction between 2 world-class PhDs, Yardeni, gentle recession, Dudley, a hard landing. Powell's not going to mention the hard landing today.
Well, and he might not mention Volcker either. In other words, whether he will be the new Volcker of 2022.
Yes.
And that is really the distinction here. How much is the Fed committed, yes, to getting to inflation back down to 2%, but imminently, right, by the end of next year, versus, say, in 5 to 10 years out? How much do they see this urgency of getting inflation expectations in check, especially after that UMich survey showed that they were creeping higher over the next decade or so?
Hey, what's interesting here, Kaylee, is dollar resiliency, but in the bond market, I mean, I don't need to do a bond data check because nothing's moved. I mean, there's a 3-day stasis here in fixed income.
Well, you are seeing yields coming in a little bit this morning, Tom. The 10-year yield is down about 7 basis points now as we speak, and it is that kind of fleeing to safe havens due to some of the growth fears out there. And I would note, too, that while you are seeing that present in the dollar, the lone Asian currency stronger against the dollar today was the Japanese yen, which, as we've been talking about for weeks now, has been so weak, yet it is getting a little bit of that haven bid back in.
I should not even come in, folks, in the morning. Kaylee Lyons is so far out in front of me. Lisa, you mentioned safe haven, and the first thing you look at is Euro Swissy, and Lyons is, of course, 100% correct. I've got Euro Swissy in after the Swiss bank, 1.02 on Euro Swissy, stronger Swiss franc.
Well, and this is also because the euro has been not supported by an ECB that has let inflation get far ahead of monetary policy that's still super easy. At what point do the central banks try for a stronger currency? Remember, it was a race to the bottom. We've been talking about this for months, but I do think this is going to be the theme for 2022, the race to a stronger currency.
One final question, Lisa. We talk about a lot of Fed speak, and you've got in the brief this morning, and that, what does Powell not want to say today? I find that always the most interesting.
He doesn't want to use the word recession, right? That we're going to cause recession. He doesn't want to say that they're willing to cause recession in order to get inflation under control. That's what he's basically intimated. And what he doesn't really want to say is that he sees a Larry Summers outlook for 5% unemployment for the next 5 years.
See that.
And that's going to be what it takes to bring inflation back to that 2% level.
There'll be a distinguished Republican senator, and Chairman Powell will go, Larry who? I mean, I'm sure we'll see that as well. Futures at -49, Dow futures -333, the VIX on a stick, 30 into a 29 briefly, and we come back 31.19. Briefly on bonds, 3.21% in the 10-year. 2-year yield out to that panic of 3.42, 3.11. Now, I'm only giving a bond data check, folks, because John from Punta Trigara, wherever that is in Capri, John says do more fixed income. The curve 10 basis points, the real yield a -0.59%. Briefly, a brief. Lisa?
I will just say bonds actually have been fascinating in their stasis because they've reached a certain
Lisa,
kind
if the
of
bond
place.
market was closed for 5 days, you would say it would be fascinating.
Well, there is a 20-year auction, so you're just lucky I didn't really talk about that today. Today, Jay Powell is going to be testifying to the U.S. Senate panel. It will probably begin around 10 a.m. and continue throughout the day ahead of the Thursday testimony to the House. How much does he talk about the dollar as a potential global destabilizing liability? The stronger it gets, the more a lot of other nations are importing even more inflation, and how much does that create a feedback loop that is problematic for a Federal Reserve that unfortunately or fortunately is central banker to the world when there is a crisis so often. Today there is a host of Fed speak, including Richmond Fed President Thomas Barkin, Chicago Fed President Charlie Evans, as well as Philadelphia Fed President Patrick Harker. We heard from Tom Barkin yesterday talking about what to expect when it comes to the rate hikes, particularly with July and a 75 basis point rate hike, really in giving some pretty strong words about why they are expecting to raise so much more than they had been just a month ago. And then we have, of course, President Biden speaking probably around 2 p.m. on his proposal to suspend federal gas tax. Basically, theater, Tom, we've all decided that, but definitely a major issue heading into the midterm elections as gas still hovers around that $5 a gallon barrel.
Yeah, it was really interesting with Anne-Marie Horton. We'll touch base with her this hour or the next, can't remember, but we'll talk to Anne-Marie here about the president's eventful day as well. Emily Rowland is co-chief investment strategist at John Hancock Investments. She knows the difference between new John Hancock and old John Hancock in Boston. We're thrilled she can join us today. I love in your note where you go to the x-axis, Emily, and say speed of cycle is everything. You note that the cycle right now is fast, like the Red Sox recovery. Tell me about speed of cycle.
Yeah, Tom, we're seeing the largest amount of financial tightening that we've seen in decades here, and that is causing the cycle to age incredibly rapidly here. We just saw this really swift pricing in of a global recession in the equity market. We're down now, of course, over 20%. We're about 2/3 of the way there in terms of your average bear market. But on the fixed income side, bonds really haven't priced in this fast-moving economic cycle. They're not even close to pricing in the potential here for a global recession, in which our odds have moved up here. So bond yields continue to rise. high yield bond spreads sitting about at 495 basis points right now. Yes, they've widened, but they're not even close to hitting their 20-year average, or they're getting closer, but still not there. So we're seeing parts of the market that really haven't reflected the fact that we're moving ever closer to a late cycle environment and even a recession here. And we think that that offers some opportunities.
Well, and let's go there, Emily, especially on the heels of what Paul Krugman was writing about earlier this week, the columnist and the prize-winning economist, talking about how we're not out of the free money era and that we're going to head right back to it when we hit recession, that yields are going to go back down. Is that what you're betting on and investing in longer-term bonds?
Yeah, it absolutely is. And in fact, we see this as almost a teeter-totter, where this year the Fed is clearly resolute in their unconditional efforts to fight elevated inflation. And clearly the gloves are off here. But that teeter-totter, we think, switches to the other side heading into 2023. We expect the Fed will be cutting rates, and we expect they'll actually be laser focused on the other side of their dual mandate, which is dealing with a higher unemployment. We think that the Fed is probably going to need to bring the economy to the brink of recession, which clearly means rising unemployment, and that's going to be a critical element next year. So normally, when you're thinking about higher unemployment, when you're thinking about global slowdown, when you're thinking about a recession, bond yields fall. You guys have talked a lot about these sort of traditional cross-asset relationships this morning, and I think that one's broken right now. So we do eventually see yields here topping out, and we think, look, you're getting 4% on the aggregate bond index. You haven't gotten that since 2010. So we think this is an attractive entry point. I tried to have a T-shirt made for this morning that said, "I love bonds." It didn't arrive in time, but I love bonds right now.
You know, there's some Twitter people out there that are pretty good with Photoshop, so I bet they're able to take your appearance and just kind of put that on your outfit this morning, Emily. Okay, so if you're buying bonds, how does that fit into your broader allocation of a portfolio? Does that mean you're shifting more toward bonds, away from equities? What else is in there?
We are, Kaylee. So heading into next quarter, we're going to be reducing our overweight to equities, bringing that down to neutral. Within equities, looking at higher quality parts of the market, adding to more defensive areas, the ones that are still on sale. A lot of the defensive sectors are now trading at very rich multiples. Barbelling that with quality, so companies with great balance sheets, good return on equity, lots of cash on their balance sheets. Those are the proverbial baby that have been thrown out with the bathwater amidst this indiscriminate selling. So still owning equities, being more thoughtful about the ones that we own, and then again, notching up on fixed income. We're notching down our allocation to credit, to bank loans, and we're looking at core as really the key opportunity here. Treasuries, mortgage-backed securities, we expect those to see a bid here as the year progresses, as inflationary pressures come down, and as investors look towards safer parts of the market heading into the recession.
Are you calling double-digit equities out 1 year?
I think that's a tough one to call here. I think that there could be some further weakness. And the key to me is that earnings estimates still haven't been revised down.
Fair.
I think you could see more weakness here. We're waiting for that to happen. But again, it's just about looking at those opportunities within equities for some relief.
Emily, thank you. Emily Rowland with us with John Hancock this morning here as we try to discern the strategy. And Lisa, it really underscores the uncertainty out there. There's almost a mystery to the uncertainty.
So the rally over the next year reminds me of John Stoltzfus over at Oppenheimer, and he has one of the highest targets for the S&P at 5330. And yesterday, Bloomberg spoke with him and said, "Do you really still think that's the case?" And he says, "Yes, I see a 40% rally heading into the year end, and that yes, it's been a difficult call, but he still has conviction on this." How many people have to capitulate? We have not seen a capitulation on a lot of the individual price targets. When do some of these year-end averages of north of 4,600 start to come down and way down in the face of all of these recessionary calls?
Kaylee, did Kellogg's capitulate yesterday? The answer is yes.
Well, you could say that in the breakup into 3 companies. They're obviously trying to do that a little bit for a tax benefit, but obviously corporations have to make decisions in that kind of environment. I would just point out, Stoltzfus far and away is the most bullish on the street, but you still have the likes of Credit Suisse, of JP Morgan, calling for something like a 30% rally.
Yeah.
They're still out at 4,900. It's a long way away from where we are this morning.
Quote of the week, lines on Kellogg, the 3 divisions, Snap, Crackle,
He's never going to let you live
and
this down.
Pop.
Ever.
I thought it was brilliant.
It was brilliant. I mean, what can you say? I mean, this is Bloomberg. I should just not even come in. Let lines run the show.
date with news from around the world. With the first word, I'm Ritika Gupta. President Biden wants Congress to do something about soaring gasoline prices. Bloomberg's learned he'll call on lawmakers today to enact a gasoline tax holiday. Average gas prices in the U.S. are around $5 a gallon. Federal taxes make up a little more than 18 cents of that. It's not clear how long the president wants to pause the tax. In the UK, inflation has risen to a new 4-decade high. Prices rose 9.1% in May from a year ago. There were broad increases in the cost of everything from fuel and electricity to food and beverages. There are also more signs of inflationary pressures building at the wholesale level. Raw material costs increased the most on record. Ukraine's President Volodymyr Zelensky has resumed lobbying of European Union officials. He's looking for support for Ukraine's bid to join the EU. That will come up at a summit in Brussels on Thursday. Zelensky is also urging the EU to come up with a 7th package of sanctions against Russia. The Senate has voted to advance a bipartisan gun safety bill, and final passage is expected later this week. Backers called the measure the biggest breakthrough on the issue in decades. It's designed to improve background checks, securing schools, and giving states federal funds to combat gun violence. And Bitcoin has resumed its fall. The largest cryptocurrency sank to just above that key $20,000 threshold. For months, cryptos have been moving in the same direction as stocks. Today's moves were no exception. Investor appetite for risk assets has been falling in the midst of fears about a recession. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Stories about what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now. We are dying slowly but surely, and our lifespan is reducing every day.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Tory cuts and tax hikes hammer home. After 12 years in government, the Tories have left the UK economy in the doldrums.
It is emotion in the House of Commons and Parliament. You wonder if we're going to see this in America as well. It has been fierce now. The gentleman from Scotland speaking, but Starmer of the Labour Party and the Prime Minister of the Tory Party have really been going at it at a much greater level than I've seen in recent times. Here's the Prime Minister. Let's listen.
Inflationary problem, but this government has the fiscal firepower to deal with it, Mr. Speaker, and that is, I think, of benefit to the whole of the United Kingdom, including Scotland, as we've seen throughout the pandemic. And I think it's a matter of fact that taxes are actually highest of all in Scotland, Mr. Speaker.
Ian Blackford. Well, actually, that is not true, Mr. Speaker, but of course...
We'll leave it there. That's a PMQs in the House of Commons. Lisa Bramwood's very quickly here. The backdrop here is simple. $8.66 U.S. a gallon in London.
Which is a lot more there, and frankly, it's creating tensions around the world as people bubble over and see that their incomes are going down on a very real basis.
We right now summarize this and move from the emotion of the floor of the House of Commons to the reality of careful academics and study at the International Energy Agency. Tim Gould of Johns Hopkins in Oxford leads their energy and economics coverage. We're thrilled that he could join us today. An extraordinary time, Tim. To cut to the chase, in the IEA report, what is the distinction that the Prime Minister and the leader of Labor need to know? What do they need to know right now from IEA?
I think one thing they need to know is that we simply haven't been putting enough capital into the energy sector in recent years. And that's true whether you look at it from the perspective of energy transitions. So we haven't been investing enough in clean. And then partially because we haven't done that, that means that the amount of money going into the traditional sector, so oil and gas, has also been not enough to avoid the sort of volatility that we're seeing today.
Tim, I've got a really basic question. Has Russian oil actually been taken off the market or just re-diverted through China, through India and the refineries there, and then sold back to the West?
So there is clearly some impacts on Russia already of the measures that are in place. But if you look at the data for exports, there hasn't been a huge amount of change since the invasion in February. And so there is that evidence of a reorientation rather than a reduction when it comes to Russian flows into international markets.
So who's pocketing the difference? I mean, if you're dealing with the gas and the crude that's being sold at a discount from Russia, and then it's being sold at anything but a discount everywhere else within the developed world, who's getting that delta?
I mean, it's an unusually profitable moment to be in the refining business right now. I mean, refining margins are very high, and refining margins are particularly high if your input crude is heavily discounted Russian crude.
Well, but quickly here, Tim, there is this allegation that some people have that actually India and refineries there are benefiting on all sides, and a lot of the gasoline and the refined goods the United States and other nations in the developed world are importing are actually Russian crude that just have been funneled into a form that they can use. Is that accurate?
I think it's very difficult to tell the provenance of the molecules that come out of a refinery. There's no way to distinguish the outputs of a refinery based on the normally based on the origins of the crude. So I think that's a very difficult question to answer directly.
Okay, Tim, well, you're an economist, and as the Biden administration pushes Congress to enact a pause on the gasoline tax here in America to provide some relief at the pump, will that actually work as intended, even if it got through Congress?
I mean, we're very focused on the underlying dynamics. And the fact is that oil and gas upstream investment has come down by half since 2014. And that's added to some of the pressures that we see on markets today. So what we're focused on is which way do we get out of today's crisis? And essentially there's two baskets of options. One is around doubling down on fossil fuels, and the other one is investing in new areas of the energy economy. And certainly from an IEA perspective, we're very keen that the upswing that we've seen in clean energy investment in 2022, we're keen to see that gain further momentum, because we think that's the only lasting way out of the crisis that we're having today.
Well, and Tim, of course, by nature, it is a transition. We don't just arrive at a moment in which we are entirely reliant on clean energy. You still need fossil fuels there as a backstop, because many of these clean energy sources are intermittent by nature. The sun doesn't always shine. The wind isn't always blowing. How do both of these things play together where we can't wean ourselves off of fossil fuels? You can't get to green energy at the same time. Does that make sense?
Yeah, I mean, that's one of the things that we try and avoid saying, is that there's a very sort of binary, clean, dirty element. You just need to scale up one and reduce the other. There is this sort of coexistence of energy systems for many, many years to come. And you need to make sure that all parts of that system are functioning in a way that allows us to have affordable, secure energy. So I very much agree. You know, we need to focus also on all of the energy services, the reliability that you can still get from traditional forms of supply.
Tim Gould, the thickness of the IEA effort here, I think of Adam Szymanski's work over the years, and then I look at Christian Malik and J.P. Morgan, where in 100 pages, they say the foundation of all of this is population growth in emerging markets. You own this at IEA. You've had the courage to go beyond the developed countries and look at emerging markets as well. Is the case for higher oil prices simply a burgeoning population in emerging markets?
I think it's more than that. It's about the economic growth. It's the rising incomes. It's the aspirations that many people in emerging markets and developing economies have for the lifestyles that we have in many advanced economies. And that is going to drive developments in the energy sector for many years to come. But the question is, what sort of model are these countries going to be pursuing? Is it the same one? Is it the same path that we've trodden all these years? Or is there a new lower emissions path that is now available because of some of the increasingly accessible and affordable clean technologies that are on the market?
Tim, thank you so much for this report from the International Energy Association. Tim Gould with us there this morning. Lisa, this really is in the J.P. Morgan report as well. Starving people in EM or burgeoning middle class in EM, they have aspirations. And those aspirations center around use of energy. That's the heart and soul of the J.P. Morgan call.
Which actually begins, or ends, I should say, where we began, which is that tension bubbling up and how that manifests itself as we head toward a J.P. Morgan call of $150 a barrel.
Are we going to get a two-year yield under 3% in 9 basis points right now, Lisa, 3.10%? That's starting to get my attention.
Wait, seriously? Bonds are starting to get your attention?
Bonds getting my
Wow. Breaking news. Yeah, I actually find this really interesting that you're actually seeing, even as you have the hawks and the Fed talking up hawkishness and even more hawkishness, you have a rally in bonds, especially as people look out to this recessionary call in the nearer term than perhaps people previously thought.
Futures at -47, the VIX 31.08. Please stay with us. Kaylee Lyons in for John Farrow, Lisa Bramwitz, and Tom Keene. On radio, on television, this is Bloomberg.
companies know they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
We are all unique. Without diversity, life would be excruciatingly dull. It's something worth celebrating. It's something that makes us stronger as communities, as businesses, and as individuals.
I see the benefits at Bloomberg on a daily basis. It's beyond flying that rainbow flag. It's about taking the discussions out into the world and making a genuine difference.
Surveillance. We look at equities, bonds, currencies, commodities. Oil down 124. The Yanks there down to a 110 level. Commodities generally giving it back. Dollar pretty much resilient. 104.51 on the blended big country DXY. Yen, very importantly, 136.20. Really doesn't give way. A persistently weak yen, I would say. Sterling, as we have heat in the House of Commons right now. We looked at that a moment ago. Sterling, a 122.47. Pound sterling can't get out of its way. Either can Lisa Abramowitz. She's got an individual stock story.
And I know this is going to be shocking to you, Tom, but they're all down because today it's a gloomy Wednesday.
There we go.
You know, today is a new day when it comes to the relationship of oil to this inflationary backdrop. There has been a shift where suddenly the inflation that's going to cause potentially a recession, if you trust the likes of Bill Dudley, who'll be joining us here shortly, that this will actually impede the demand for oil. And you're seeing that with oil prices down, and you're seeing commensurate declines across the board in some of the majors in the oil sphere. Chevron, interesting, notably because of the tit for tat yesterday between President Biden, who shot back at the Chevron CEO, who said, guys, we need more clarity, we need more supportive policies for the oil industry for us to be able to produce more. And then President Biden came back with, I didn't know you guys were so sensitive. Well, those shares down nearly 3%. ExxonMobil shares down about the same percent. This is really in sympathy with what we're seeing in the crude space. And then Occidental down about 3%. I wanted to take a look at a couple of the winners and losers, even after yesterday's rally. Tesla was one of the big winners yesterday, up more than 9% after Elon Musk talked about job cuts and gave a little bit more clarity, maybe, on Twitter. Those shares now falling 1.5% as people reassess, and because of this sort of broad-based risk-off field. Netflix and Meta are interesting. Facebook, because yesterday they did not participate in the rally. Netflix actually is suspected to announce another round of job cuts after really beefing up during the pandemic. Those shares down about 1%. And Meta has really been left out, Tom. I mean, some of the losses in the big tech space, just shocking. And a lot of people saying, not time yet to get back in. One of the big bets about what could potentially drive a rally. This is it, right? At what point is there value in names that really were bid up on ultra low rates for so many years?
The Bramo stock check. We only show red on the screen. Thank you, Lisa, for
anytime
doing that. Romaine would have done it differently. There's no question about that. John Farrow off. Kaylee Lyons, rather, in for John Farrow with Lisa Abramowitz and Tom Keene. And now we're going to go a little bit inside baseball. You can do that with Patrick Garvey, head of global debt and rate strategy at ING Financial. Patrick, you talk a lot about the dynamic, the flows into what I call the trust market, which years ago was indicative of the TED spread, the dynamics against treasury bills and just the thermometer, the measurement of the very short-term paper. Suddenly the TED spread jumps up. Should I care?
It's up, Tom, but it's not anything dramatic so far. One of the things I've been really impressed with is systemic risk is relatively subdued, which may seem like a strange thing to say given the sell-off in risk assets. But if you look at where banks print CP relative to the risk-free rate, it's relatively subdued. Now, it's up, as you say, it is up, but we're not anywhere near panic levels. The banks are holding up and the system is holding up quite well, in fact.
Are we not at panic levels because we had so much fiscal stimulus that there's so much money sloshing around in the system that there's just so much money we don't have to panic, just that simple?
That's been a real comfort blanket, Tom. It's been there, of course, since the pandemic, and it remains in play. One of the things I really missed from the last FOMC meeting was commentary on this, because you mentioned the TED spread. I mean, the other dynamic on the front end is SOFR, which is our risk-free rate here in the US, which is now 10 basis points below the Fed's reverse repo facility rate and 5 basis points below the Fed funds floor, which is not a good look. And it does reflect this excess of liquidity. It's not helping risk assets, but it's certainly pushing down repo rates.
We're speaking with Porrick Garvey, head of global debt and rate strategy over at ING. And I am curious, Porrick, a lot of people trying to game out what a recession would look like. When you look at the credit space, the bottom-up analysis, what are we pricing in terms of the type of recession based on the credit spreads currently priced in?
So credit spreads are pretty wide. I mean, if you look at a spectrum of wideness, where we're at that level where things can begin to creak in terms of an elevation of default risk. Because again, one of the real positives of the here and now is that defaults, actual defaults, are historically low. So what I see with this elevation of credit spreads is a pickup in defaults as we go into 2023, and we have a slowdown. We're not there yet, though. I hear a lot of talk about imminent recession. We have a really strong labor market here in the US, and that's the ultimate test of whether we're in recession or not. We're not there yet.
Wait, hold on a second, Porrick. This is really interesting, especially as you get Bill Dudley, who's coming on next, saying that a recession is imminent in the next 12 to 18 months. You're saying not so much. How much does that view hinge on a Federal Reserve that backpedals away from the Volcker-esque policies that at least is in their rhetoric when they testify and when they have just given out their 75 basis point rate hike?
Yeah, I think we have to define imminent, Lisa. 12 to 18 months is quite some way away from today. If we're talking about 2023, I'm fully on board with the severe slowdown camp. But we're still in 2022. It's just June. And from a bond market perspective, there's a lot of talk about, should rates be falling here, market rates falling. They have come off the highs, but I don't see it just yet. I see a lot of reasons for market rates to rise further from here, which I can go into, but we're just not there yet.
Speaking of we're not there yet, we have barely begun, Porrick, quantitative tightening. I mean, June isn't even over. We're only a couple weeks into this. How far away are we from seeing the actual real impact of that, rate hikes aside?
I think we're a good 12 months away, Haley, to be honest. I mean, this is one of the anomalous situations that the Fed is doing 50 billion per month to begin with, then 100 billion. So before we get real traction there, I mean, I think that, you look at the cash going back to the Fed, it's $2.25 trillion going back to the Fed on the reverse repo facility. I mean, that tells me that the Fed needs to get that balance sheet down by 1 or 2 trillion before we have a real impact. So we're talking about 12 to 18 months before there is an impact from that policy unwind.
Yeah, of course, everything operates with a lag. As for how this translates directly into the Treasury market, what are your expectations about not just what the nominal yield is going to do as it balances the expectation of higher rates with these growth concerns, but also where that is going to be driven from? Is it real yields or break-evens?
Oh, it's absolutely real yields going forward. We've been talking about this for the past few months. Back in March, we had a real yield in the US minus 120 basis points. It's now 60. So that's a big move, but 60 is still low. And this is one of the reasons to why we do think rates can rise from here, because, typically before the pandemic, the real yield was up around 1% in the 10-year. And that seems to me to be still a very sensible target, given that this economy is still hot on the labor market. So that's the first thing. Second thing I'm looking at is the 5-year on the curve, getting a bit technical here. It's not signaling that the rise in rates is over. It's still trading quite cheap to the curve. It's a classic sign that the Fed has got a big job to do and that market rates still have some rising to do. Now, having said that, I am expecting rates to peak this quarter. We're just not there yet.
Well, you said peak this quarter. What is your terminal rate here? As we go to Bill Dudley, we'll have in a moment, folks, with a blistering hard landing memo today. Mr. Garvey, what is your terminal rate then for the Fed that Mr. Powell needs to describe later this morning?
375, Tom, is where we think it gets to, so it just falls short of 4%. Gets done by the end of this year, and the market should discount that in Q3, which leaves Q4 and next year as a period during which we can see market rates fall. This has been the biggest bear market in modern times. Plenty of room for some positive times for bonds once we get beyond this quarter and we discount cuts next year.
Pedro Garvey, thank you so much. Greatly appreciate it with ING. And Lisa, that alludes back to Margie Patel earlier, where I looked at the high yield Bloomberg Total Return Index. And it's just, I'm still not there. It's something I've never seen, as Mr. Garvey alludes to. The idea of double-digit declines, in this case, high yield prices, I believe it was a negative 12%.
Which is the reason why Porrick was talking about what is getting priced in, and he doesn't see defaults getting to the level that currently is getting priced in by spreads. The reason why some people are saying, including Emily Rowland, we love bonds because there actually is value. I want to highlight this, Tom. Andrew Hollenhorst over at Citi just publishing about what to expect from Chair Powell today. This sort of reiteration of a message that inflation is too high and the Fed is determined to bring it down. And he really highlighted this, and I think that this underlines the moment and kind of the feeling right now. While not new, the repetition of this message as markets increasingly price in the risk of a near-term recession increases the hawkishness of the message. This reiteration that they are committed to 2%, how much does that really emphasize the bearishness that you're seeing seep into markets today?
Let me ask the two of you. Kaylee, let me start with you. Do you discern a difference or a nuance recession to recession? Because those of us older do.
Well, I think that's the question, and that's kind of the conversation that you are having now. It's not just about whether or not we're going to get a recession or even what time it arrives. It's how deep it will be. Is it going to be short-lived, or is it going to be one that is very difficult to come out from? I think the nuances do indeed matter here, because the fact of the matter, Tom, is that this recession will be also very different than anyone we have had in the past. Just as the pandemic, very short-lived recession was. The question is going to be, how short-lived will this be when it eventually arrives?
Let me do a data check here, because we're going to get to Bill Dudley. Please, all of you on radio and television, stay with us. We're going to look at the news, a very busy day, and then get to Dr. Dudley. Futures negative 47. The VIX, it's a little better tape than 20 minutes ago, an hour ago, but still a negative tape, negative 47 with a VIX 31.07. I should mention Bitcoin with a print under 20,000 overnight, 20,500 on Bitcoin right now, and the 10-year yield 3.20% in a lower yield by 8 basis points. Please stay with us. Bill Dudley is next. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Boeing CEO sees supply chain issues lasting until the end of next year. David Calhoun also told Bloomberg's Guy Johnson that's not the industry's only problem.
We have a very large, sophisticated, and somewhat fragile supply chain behind the airplane manufacturers. And just as fragile, it turns out, are the operators themselves, the airlines, and the ability to staff up with pilots, the ability to staff up the ground crews, maintenance crews, etc.
Calhoun was interviewed at the Qatar Economic Forum in Doha. Bloomberg's learned that President Biden will call on Congress to enact a gasoline tax holiday. The president's expected to make a statement today. Average gasoline prices are around $5 a gallon in the U.S., and they typically rise in the summer. Federal taxes are 18.4 cents a gallon. It's not clear how long the president wants the tax to be paused. The CEO of Deutsche Bank sees a growing risk of a global recession as the global economy battles multiple strains, from supply chain issues to rising food prices. Christian Seving spoke at the Future of Finance Summit over in Frankfurt.
It's always hard to put a percentage, but at least I would say we have a 50% likelihood of a recession globally, but also in Europe.
Seving also said that volatility will be the theme for the next 12 to 24 months. Ford has picked its factory in Valencia, Spain to build electric vehicles, and the American automaker will wind down a plant in Germany by the middle of the decade. Ford says it will talk with unions about significant job cuts at both plants because electric vehicles require fewer workers to produce them. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We are in a situation where inflation is high, it's broad-based, it's persistent, and rates are still well below normal. And so I think the spirit is you want to get back to where you want to go as fast as you can without breaking anything.
A really important conversation with a gentleman from Richmond. Richmond has a different economics in the air. Mr. Barkin there with important comments on the item of the moment, recessions in America. The chairman will speak today. It will be a sober conversation, a sober set of Q&A, and part of it will be reading William Dudley's essay for Bloomberg Opinion this morning, where Bill Dudley, the former president of the New York Fed, of course, for decades at Goldman Sachs, simply says, learn how to spell it. It is a hard landing. Bill Dudley, how do you know or discern a recession coming? The distinction of a 1994 soft landing, looking at a Goldilocks recession, if you will, of Greenspan, or a more difficult recession. How do you get out front of that intellectually?
I don't think it has to be a really deep recession. I mean, deep recessions typically occur when something breaks, like the global financial crisis is a good example of that. I think what the Federal Reserve has to do is generate enough slack in the economy to bring down inflation. That means the unemployment rate has to go up. The problem that the Fed has is it's very hard to push the unemployment rate up only a little bit. Every time the unemployment rate's gone up by more than 0.5%, you've had a full-blown recession. There's no reason to think that it's going to be any different this time.
Will the chairman today say what you say in your essay, that suddenly employment as a mandate is subservient? Is that where we're heading?
Well, that's what the Fed already sort of told us in their FOMC statement. They took out the reference to the labor market remaining so strong. They're very much focused now on inflation as opposed to employment, because the labor market is too tight as opposed to not tight enough. So I think he'll reiterate the message that we heard in his press conference last week. I think also, though, he will not talk about a hard landing. The Fed is still going for a soft landing, and of course they should. The problem is it's just going to be very difficult for them to pull this off.
Bill, a lot of people in the market right now are trying to draw a distinction between a soft recession or a shallow one and one that is much more damaging. What is the characteristic of the hard landing you envision?
Well, I think it's going to be a relatively mild recession at this point because the financial system looks like it's pretty solid. Household and business balance sheets look like they're pretty solid. You really get a deep downturn when things in the financial system break and the ability to supply credit to people becomes impaired. I don't expect that to happen this time. So I would expect a mild recession like 1990 or 2001, not a deep recession like 73, 74. Or, of course, the great financial crisis.
A lot of people would push back, Bill, and say that this Fed has no appetite for causing a recession. They don't seem to want to do that, and that they will eventually pivot away from raising rates as much as people currently expect. Why do you think that's not the case? Why do you think they're going to take a page from Paul Volcker?
Well, I don't think they want a recession. The problem is that if you're going to get inflation down, you need more slack in the economy, and it's very hard to generate more slack in the economy without actually generating recession. So that they're definitely going for a soft landing. It's just going to be almost impossible for them to pull it off.
But is the assumption you're making, Bill, that they're not going to blink even when the data turns more dramatically than we already have seen it having? I mean, Larry Summers was talking about a 5% unemployment rate over the next 5 years. Where do you think their tolerance is?
Well, I think what Larry's talking about is certainly reasonable. I think the reason why they're not going to blink at the end of the day is they know that if they blink and don't get inflation down, then they have to do even more later. Procrastination is not a great option. We saw what happened in the 1960s and 70s when the Federal Reserve was slow to tackle inflation. What happened was inflation got out of hand and Paul Volcker had to come in and put the U.S. economy through the ringer. So the Fed wants to do what's necessary in the near term so they don't have to do a lot more in the longer term.
But it is in the longer term that you really see the full effects of monetary policy taking shape. It operates with a lag. We all understand that. So I guess the question is, if they're front-loading and aggressive, are they going to see it reflected in the actual data we're getting, or do they risk just moving way too aggressively and then the data turns all at once?
Well, that's what could actually happen, because right now the economy has considerable forward momentum as the economy reopens and payroll gains are very strong. Household balance sheets are still very solid, boosted by the fiscal stimulus that we got over the last couple of years. But beneath that, things are troubled. Inflation is rising faster than wages. Financial conditions have tightened a great deal. So what I think is going to happen is the economy is going to be fine over the next few months, and then we're going to see a very sharp slowdown, probably in the first half of 2023.
Bill, I just want to build on something that Kayleigh was talking about with that 5% unemployment figure from Larry Summers over the next 5 years, and that's what he thinks is necessary to bring inflation down. What happens if you start to see the unemployment numbers climb, but the inflation figures do not come down because of those lag effects, like rents, for example, that are continuing to climb? How does the Fed handle that based on your conversations and your experience on the central bank?
Well, I think you're right that inflation is probably not going to come down that quickly because there are lags in price rate in companies raising prices. Also, I think the Ukraine-Russia war complicates things enormously because it looks like the energy price shock and the food shock is going to last longer because of the war. So I think that the Fed has gotten very unlucky in terms of the kind of inflation shocks that we're seeing. They're likely to be persistent, and that's going to make it difficult for the Fed to reverse course.
Bill Dudley, John Taylor's at a school, you may know it, across the bay from Berkeley. It's Stanford, I think is what it's called. And I can just see John Taylor with a full balloon in his freshman economics class, letting the air out of it ever so slowly. We have a fiscal balloon, some 30% of GDP. How long will it take to let the air out of that fiscal balloon? As a central bank, is that a 3-year project, or do you really see it out almost to a decade?
I don't think it should take as long as a decade, but fiscal policy is a factor behind why we're probably going to see a sharp slowdown at some point. Because fiscal policy, while it has been very stimulative over the last 2 years, that stimulus is over. We've also seen households begin to pull down their savings rate. So the savings rate was very elevated as the fiscal policy stimulus was being put in place. But the savings rate now has already fallen below its long-run average, which tells you that consumers are a little bit stressed, are starting to experience a little bit of stress in terms of their balance sheets.
Bill Dudley, required reading, folks, before the testimony of Chairman Powell, the Humphrey Hawkins testimony, a monetary report by the chairman of the Federal Reserve, and we'll get Bill Dudley out on social here as quick as we can. You can see that, of course, at Bloomberg.com. He speaks of a hard landing as well. Bill, I look at this and I think if Jerome Powell was to read your essay, you wonder how he would amend his discussion today. I mean, he's not going to say hard landing, but how does he how does he address the probabilities, the set of outcomes that we may see?
Well, he's made it more clear that it's going to be more difficult. The longer inflation stays as high as it's been, the harder the Fed's job is. And he's admitted that in his press conference. So I think today he's going to make it clear that this is not going to be easy. He's going to talk about that there is a path to a soft landing. I think that path is extraordinarily narrow. He won't talk about how narrow that path is. He'll just talk about that's what the Federal Reserve is trying to seek and pull off this time.
Bill, what kind of financial breaking do you foresee being a trigger for the Fed? And I say this as the yen weakens to the weakest levels we've seen versus the dollar since 1998. And people are starting to get concerned about deteriorating liquidity in certain bond markets.
Well, I think the biggest area of stress, frankly, is going to be low and moderate income countries who are hurt by, one, a stronger dollar, higher grain prices, and higher energy prices. For poorer countries, grain and energy is a pretty significant portion of the household consumption basket. So they're going to be hit very severely over the next 12 to 18 months. So I expect a lot of sovereign debt problems in the next year or two. And that's going to just be more problematic for the global economy.
So, Bill, at what point does a strong dollar create a real issue? And this is something that I was thinking about, especially as a growing number of investors see the dollar as the main hedge against equity weakness. At what point is it a trigger for the Fed?
Well, the Fed actually is not unhappy with the dollar being stronger because a stronger dollar holds down U.S. inflation by making import prices cheaper. And it also slows down the economy by reducing U.S. export competitiveness. So when you think about the Fed wants tighter financial conditions, higher bond yields, weaker stock prices, stronger dollar, the dollar is actually the most attractive of those three things because a stronger dollar actually increases your purchasing power. So the dollar strength is not something the Federal Reserve views as a bug. They view this as a feature.
Well, speaking of the financial markets, we heard from Tom Barkin yesterday. We will again today, but he essentially said that you want to get back to where you want to go as fast as you can without breaking anything, talking about not wanting to cause undue harm, not just to the economy, but to financial markets. What harm would that be? What would make the Fed kick back in, Bill?
I think you'd have to see some sort of calamity in financial markets that impeded market function, impeded the ability of banks to lend money to households and businesses. I don't expect that. I think the reforms that we made following the great financial crisis in terms of the banking system, more capital, more liquidity, better risk management, better governance, those have shown to work, and I think they'll work this time as well.
Bill, I just want to say in your wonderful essay, I don't know which is more important, that you quoted the great economist Claudia Sahm or you quoted the other economist Wile E. Coyote. I'll let you decide which one. I think that's great to see here. Bill Dudley, thank you so much, the former president of the New York Fed. I think, Lisa, it's great to talk about the Sahm rule, which really speaks to the dynamics of what a central bank has to deal with in employment. But the single sentence, Lisa, from Mr. Dudley, personal savings rate with all the challenges of inflation now for the country, moving from 27% to 4%. That is jaw-dropping.
And it's something, yeah, and it's something that people are talking about as we do get, as people eating into their savings to keep their spending up at a time when inflation is running at the fastest pace in 40 years. This idea of a recession and the contours of what kind of recession it will be is the debate of the moment. It is no longer how likely it is to avoid that kind of downturn, but how painful it will be and what the scars will be. And that, to me, is interesting to note in some of the rhetoric we're hearing out of Wall Street banks and investors.
And of course, Wile E. Coyote, I think he's out of Berkeley as well, a little bit behind Dudley. But Wile E. Coyote, of course, making clear in a recent research report, we are at the Brammo Cliff. I mean, there's just no question. I mean, come on, Lisa, there's no question about that.
Yeah, Wile E. Coyote really likes Tang and Velveeta. It's really, you know, it goes to the same genre.
Quoted by Dr. Dudley, I should say, folks, I really suggest a quick skim of that essay here before we hear from Chairman Powell. Kaylee, what will you listen for from Chairman Powell today?
I think it's more about the words he chooses not to say than the words that he does, Tom. Will he actually utter the word recession?
Well, he may not say that, but I totally agree. It's about what he avoids today as being germane. Futures steady, a -50 on S&P. Futures, Dow futures -358. Yields in 7 basis points. Recession in the air. This is Bloomberg. Good morning.
almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada, 1-2 itu ada. Tapi nggak kayak dulu, kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu. 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
We are seeing signs that consumers are likely pulling back on spending.
We're one hurricane or one major refinery outage away from a significant uptick. We have crude structurally aiming higher.
A lot of this demand, I think that is going to abate over time.
The consumer, we think, can come out of this, but it will be a consumer-led recession.
Even if you were to get a recession, it's likely to be a very mild one.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
And we're examining the contours of a recession. Good morning. This is Bloomberg Surveillance on Bloomberg Radio and Television. Tom Keene, John Farrow, Lisa Abramowitz. John Farrow off. Kaylee Line's very much in, which is a wonderful thing. And it is a gloomy day in markets. Tom, it is hard to see whether Fed Chair Jay Powell will say anything to really address that in a positive way, or frankly, whether he wants to.
Well, it's become more important, I would suggest, in the last number of hours. Some of that's international with the continued weakness in Japanese yen. Some sophisticated angst out there and maybe distant for our radio listeners and television viewers. But the fact is, there it is. He's not going to discuss Japan directly, but he's got to discuss here how central banks, Lisa, are adapting to inflation, 9.1%. in the United Kingdom.
Sophisticated angst. I like that. The sophisticated angst of a yen that's the weakest since 1998. At what point does something start to break, Tom? Is that a stress point?
I think that's going to come up.
The yen at that level.
No, I really think that this idea of we're in control, obviously, as we just heard from Bill Dudley, we have a chairman who's going to say, hey, we're in control, we've got it, we've got everything in order. But the question you're going to hear from the senators is simply, what could lead this to break? And they've got a laundry list of worries, just like you do.
Yeah, and Kaylee, a lot of people are looking at stock valuations after what we've seen, the bear market, and how much things have gotten beaten up, and saying, we've already priced in something that looks like a shallow recession, as even Bill Dudley seems to project out. So are we starting to see the beginning of a new investment cycle? I mean, it's sort of a counter to some of the gloom that we hear out of prognosticators.
Yeah, well, it's a question on how much you think the market does need to price in. Will the recession actually be shallow? If you listen to Mike Wilson over at Morgan Stanley, he says this market is not prepared whatsoever for the kind of economic downturn we're going to see, which is why he's looking all the way down to 3,000. Yet you still have, as you pointed out in the last hour, Lisa, John Stoltzfus over at Oppenheimer out at 53.30 for the S&P 500 at year end. Where are futures this morning? 37.15?
Yeah, he's expecting a 40% rally, and you've seen that in the single names as well. Bespoke Capital came out with a study showing that the divergence between where stocks are and where they are priced to be by individual stock analysts is the widest that it's been, or one of the widest, going back to 2000. Where is the capitulation, and have we seen it already in price, Kaylee?
Well, I think that's the question. We've all been looking for capitulation for months now, and we never really seem to see that kind of disorderly selling pressure. For the large part, it's been quite orderly. There is a kind of a pattern and consistency to this market. It hasn't really felt like you get that, what do we call it? A cathartic?
Yeah.
A cathartic puke?
Yeah, I've been instructed.
Did Tom just wince
I've been instructed that. No, he wants the sophisticated angst, Tom. The sophisticated angst can be felt in the dollar, and the dollar strength is the pervasive move. And we talk about the flip side of that, which is the weak yen. But the strong dollar really has been the uniting theme over all of these risk-off days, the remaining hedge at a time when bonds, as you've pointed out many times, have been unreliable.
And something that maybe speaks to the difference of a more unionized continental Europe and London and the United Kingdom versus now. But the drama, folks, for those of you in America, the drama in the United Kingdom right now is tangible, Lisa, witnessing sterling can't get out of its way, 122.46. They have the biggest railway strike in 30 years. This goes back literally to Thatcher.
And it's at a time when people are relying more on public transportation because of the cost of petrol and the fact that it has been rising as much as it is. Very much risk off across the board right now. As we see that pervasive decline, we could see the S&P clawing back a little bit off earlier lows, 1.4% decline. NASDAQ down 1.5%. And you can see bonds getting a bid in. And to me, this is the change, and it really comes in tandem with crude going down to 103.90, down now more than 5%, Tom. Bad news is now bad news for oil, because a recession is not going to be good for demand when you have people who are going to decide not to drive or not to fly.
The petrol distinction right now, $8.66 in the United Kingdom versus $5 whatever here in America. Someone that has seen the arc of this, Lisa Shallett, from the mating of Alliance Capital and Sanford Bernstein years ago over to her duties as Chief Investment Officer at Morgan Stanley Wealth Management. Been there, done that. She has seen the dreaded conversation of recession. Lisa, how foolish is it for Morgan Stanley clients to angst over the guesstimates of what recession will be?
Look, we've always said that it's foolish for clients to try to guess. I mean, one of the things that we were talking about with clients yesterday is even some of the folks who get paid to do this, i.e. at the Fed, have never gotten recession forecasts correct, ever. I think this is something that David Rosenberg also wrote about yesterday. In his wonderful piece that he puts out daily. And the fact of the matter is, the best we can do is try to ascertain direction and relative order of magnitude. And other than that, I don't think we can try to, hand wring about, where the bottom is and, how far will it go and what, is going to be affected until we're really, kind of in it.
Well, hand-wringing aside, when you look at the tea leaves and this idea that certain tech companies in particular are starting to lay off members of their staff or cut back on hiring plans, Lisa, have we entered a new phase of the economic cycle that is beginning on the edges and requires a shift in strategy?
I think that we're actually, as you know, markets always, are 6 to 9 months ahead of reality. I am in the camp that the price action we have seen thus far, this bear market, has probably discounted at least 2/3 to 7/8 of the way there to what we're guessing, and I use the word guessing, is going to be a shallow recession. In that spirit, I think what's different about the labor market this time is that, we have never had the number of job openings and the ratio of job openings to applicants that, we came into this period having. And so while we are starting to see some modest uptick in layoffs from, some handful of companies, I think that what's going to be different this time is that labor and the unemployment rate is actually going to hold up much better because we have this cushion that what companies will do first is eliminate their job openings as opposed to going immediately to firings and staff reductions.
Well, on the subject of labor, higher labor costs obviously are one of the higher cost companies are facing, raising the question of margin pressure as there's continued kind of inflationary dynamics in this economy. What are your thoughts on the trajectory of margins from here, Lisa, and if expectations of them are still too high?
Absolutely. Look, I mean, back in the fourth quarter of last year, one of the things, that we were, trying to be very loud about was the unsustainability of margins. We felt that, when we were seeing these peak operating margins for the S&P 500 well into the double digits, profits as a share of GDP where they were, that we were witnessing, record operating leverage that was a result of this mismatch between, the pricing power that companies had at the beginning of the reopening of the economy and their actual costs. And there are lags because of the way we account for inventory and the way we hire and the way, we expense CapEx and things of that nature. Now we're in the catch-up phase, and our view is that margins are really going to be vulnerable. And this has been one of the, great mysteries, I think, is why the sell side has been so complacent with regard to earnings estimates.
Lisa, this is critical. This is right where I wanted to go, running out of time. If the sell side has been complacent, are we going to be surprised by corporate use of cash that shrinks?
Potentially. And I think that this has been the problem, is that the sell side analysts have stopped actually doing work since the era of, Reg FD, and, they just listen to what executives say, and executives don't want to say anything until the exact minute
Lisa,
that their lawyers let them say it.
It's our third rail, Lisa. I've been screaming here. You don't see this, folks, off camera, but I've been screaming about Reg FD and the effect here on surprise. I mean, Lisa, it's tangible. They can't talk until they're right there.
They can't talk until they're right there, and the analysts have stopped doing work, and they just listen to the words coming out of the mouths of either corporate managements or our Federal Reserve chairman. It is really awful, and investors are smarter than that. And our guess is that there is a large amount of the earnings disappointment that has been priced in. We just need to see those estimate cuts kick in so that we can ascertain what is the real price earnings ratio of this market. I mean, right now, I think it's a bit artificial.
Bottle it. Lisa Shallot there with a quote of the week. Lisa Shallot, Morgan Stanley, thank you so much. Lisa looks at me like, what are you talking about? And the answer, folks, is Reg FD changed the way the sell side communicates with corporations. And this is the first time, Lisa, we've really hit full face. Can Netflix say how bad things are until a precise moment where they say how bad things are?
In other
There's
words,
no warning.
Right. And are we going to get more Amazon-type moments where suddenly you get a complete rethink of what the outlook is?
Yeah.
And it really is not telegraphed in any kind of way that is normal. And how much does it take for the analysts to actually capitulate on their expectations ahead of that?
I was a card-carrying member of the Fun for Lunch bunch where you'd go listen to corporations. And I can tell you, folks, within 5 days after Reg FD came in, those lunches dramatically changed because their lawyers were afraid of what corporations could say. This is important. Equally important, our interview of the day on foreign exchange, Mark McCormack coming up here. Futures at -54, the VIX, 31.06. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden wants Congress to do something about soaring gasoline prices. Bloomberg's learned he'll call on lawmakers today to enact a gasoline tax holiday. Average gas prices in the U.S. are around $5 a gallon. Federal taxes make up a little more than 18 cents of that. It's not clear how long the president wants to pause the tax. In the UK, inflation has risen to a new 4-decade high. Prices rose 9.1% in May from a year ago. There were broad increases in the cost of everything from fuel and electricity to food and beverages. There are also more signs of inflationary pressures building at the wholesale level. Raw material costs increased the most on record. North Korea's Kim Jong-un may be setting the stage for his first nuclear test since 2017. For the first time in a year, Kim convened a top-level meeting of the country's military. One of the key elements of North Korea's strategy is testing miniaturized nuclear warheads to fit on a new generation of solid-fuel missiles. And the Senate has voted to advance a bipartisan gun safety bill, and final passage is expected later this week. Backers call the measure the biggest breakthrough on the issue in decades. It's designed to improve background checks, securing schools, and giving states federal funds to combat gun violence. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Without diversity, life would be excruciatingly dull. It's something worth celebrating. It's something that makes us stronger as communities, as businesses, and as individuals.
I see the benefits at Bloomberg on a daily basis. It's beyond flying that rainbow flag. It's about taking the discussions out into the world and making a genuine difference.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
It's a market where the Fed is working against you, financial conditions are tightening, and that means you need to be patient. There's pressure on the ECB, there's pressure on the Bank of England, there's pressure on the Bank of Australia. A lot of countries right now are playing catch up when it comes to getting inflation under control.
There is international economics now, as described by Russ Kosterich of BlackRock yesterday, Chairman Powell this morning. Lisa saying headlines coming out. Help me again, Lisa. 9:30, we see headlines, and then opening statements at 10, and then finally he speaks.
Well, and the opening statement is expected to be short and a reiteration of what he's already said.
Yeah.
What I'm more interested in is the questioning and, frankly, the answering. What does he avoid saying, as Kaylee pointed out earlier?
Right.
And how much does he double down on this idea that they are willing to spur a recession
Right.
if that's what it takes to bring inflation down?
Kaylee Lyons with us today. John Farrow out on a well-deserved week. Is it a week or 2 weeks he's off, Lisa? I can't remember.
It's 1 week, and it's
He's
well-deserved.
British, so, you know, and it's not a vacation, it's like a holiday.
What's the difference?
He's trying to knock him for being British.
It's like a holiday.
You quote the Dow, you mock the holiday. Are you going to start
Like
doing a
they
British
actually,
accent?
no, he actually goes on vacation, unlike an idiot like me who's glued to my phone the whole time.
Wait, can you do
Going,
that one more time?
OMG, look at Japanese yen.
People on radio.
Pass me a punch. Okay.
Tom is having, you know, a moment.
Futures deteriorate, -59 right now. What happens is you try to get somebody quick when there's sudden moves and they can't attend. Mark McCormick yesterday was in line for Toronto Maple Leaf season tickets. He does that with Toronto Dominion Bank up in Toronto. He joins us now, global head of FX strategy, after begging for him to come on yesterday. Mark, explain to our American listeners and viewers why they should pay attention to the institutions of Japan and their experiment with modern monetary theory.
Yeah, thanks. So, yeah, I guess vacation is when you don't log into your Bloomberg for a week. But in the context of, yeah, and it's quite interesting because, again, we're back to, we know the BOJ, what they're trying to achieve psychologically. It seems like they want to earn more credibility on inflation, get five-year inflation expectations higher, maybe potentially try to push wages a little bit higher, and even get past the July upper house election. But I think what's interesting is we are now kind of focused on what are the internal drivers of what's happening in Japan and the external drivers, which really relates back to oil, terms of trade, and rates. So I think what we're seeing here is the market's really worried about recession fears. 50% chance priced in across the U.S. and other countries. So if rates are starting to turn over, real rates are capped, and oil prices are down almost over 10% from the peak. The question around the yen is our models that kind of track these things are telling us dollar yen should be around 130. But you know, what's going to push dollar yen a little bit higher in the short run is the market still has to kind of push away from what the BOJ's done, which is continuing to try to weaken the yen. So we're kind of stuck between a rock and a hard place where there's just a lot more volatility, more uncertainty. But it feels like fading dollar yen is still kind of a decent trade in the very short run.
And tangential to that, down the Pacific Rim, Mark, all of a sudden I got something like dollar Thai baht, weaker Thai baht, almost log convex, which means there's an acceleration to the weakness, and I got a 10% depreciation from February. Does that matter for Chairman Powell today in the crucible of the Capitol?
Well, I think what matters for Powell is really, again, the context around the international inflation environment. So I think what he talked about a lot, and I think everyone's focused on in the market, is the month-over-month inflation print. Like, that is the barometer. Every client that we talk to that's really trying to think beyond inflation in an asset allocation framework that's beyond inflation is like, what does the next month-over-month print do? And I think, again, a big driver of this is really commodities. So if, like, oil has started to, in week over week and month over month terms, people are feeling a little bit more confident that maybe they can put on non-inflationary based trades and try to hope that we're in the peak inflation environment.
I mean, Lisa, it's never going to come up today, but I'm sorry, the international study that Mark McCormick does is germane to what Powell will say.
And Bill Dudley actually pointed to this as the potential pain point, the idea of an emerging market issue or some sort of mass disruption as the dollar continues to strengthen. Mark, do you see that as something that is plausible, if not likely?
Well, I think what's interesting is there's and we talked about it in our note, is that it's like there's a lot of different structures around the world. The number one question we're getting is like, when does the dollar peak and when do we see RV trades come back again? And that's where we were even in the first half of the year. So within EM, it's about fragmentation. There's countries that look like they have what I would call reflation, where there's decent growth but still high inflation. There's countries where you have stagflation, which is weak growth and high inflation. And there's actually countries all throughout Asia where growth is slowing and inflation is slowing, and that's China. So what you're getting is policy divergence. Asia is still basically trying to boost the credit cycle. They're easing financial conditions versus the U.S. tightening financial conditions. So you can get a weaker renminbi, but a lot of people are saying, well, where can I invest? I want to buy where financial conditions are easing. So people are talking a lot about moving into Asian equities, and therefore you do have limitations on how much these currencies can weaken. So what you get is emerging markets. It kind of depends on which country. Like SEMA is very challenged, obviously, because it's just a satellite connected to Russia. But I think people are focusing on, I can see a weaker renminbi. I could see maybe a stronger Korean won. I could see a stronger Aussie dollar, largely because China's stimulating while the U.S. is being priced higher for a recession. So I think the divergence trades are actually becoming quite interesting again, where emerging markets are kind of unpacked into different regional prospects rather than just thinking the whole group of whether they underperform versus the U.S. dollar.
Mark, I realize the answer to this question may differ depending on what currency you are talking about, but where is the line between where tighter policy is helpful to a currency and hurtful?
Yeah, I think it depends on the context that we're in right now. So if we're talking about high inflation and weak growth, what's really critical is trying to maintain policy credibility. You've seen it in LATAM. If you kind of look at like which currency baskets have outperformed the most this year, LATAM is still positive. Largely again because you got higher terms of trade, you've got higher oil prices, you've got central banks that have been very aggressive and active. And again, the conversation is even around peaking inflation, there's conversations of like whether or not you start receiving rates in Mexico and Brazil, which is not exactly the type of trade you would have. So I think the line here is who has established the most credibility around inflation. And while we're pricing in recession risks, which countries still have the ability to stimulate on the growth side. And this is where Europe is becoming quite interesting. We are still getting fiscal stimulus coming from the Eurozone. And if they can actually pull together something that alleviates the fragmentation between bonds and BTBs, then you have a credible policy, even though the market doesn't really like the euro. You've got something that's starting to come together that could really anchor the euro in the next 6 months.
Mark McCormick, thank you so much. We're out of time. Global Head of FX Strategy, TD Securities. Lisa, I missed this headline. It was about 40 minutes ago. This is Putin of Russia, and he's channeling Jim O'Neill. BRICS are working on a basket-based reserve currency. I think that's Brazil, Russia, India, China. I think those are the BRICS, Lisa.
The bigger issue to me is how do they get away from the weaponization of the U.S. dollar in the same kind of way, and can Russia get some support in that for a reserve currency that could compete?
It's about as likely, the BRIC reserve currency is probably about as likely as Manchester United winning. So
you're going to get some hate mail.
You're
going to get some serious hate mail.
Next, Abby Joseph Cohen. This is Bloomberg. Good morning.
nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Bloomberg surveillance. Good morning, everyone. Futures negative 60, a little bit of a deterioration. Katie Lyons in for Jonathan Farrow, Lisa Bramowitz, and we're here to really address Chairman Powell today. We'll have some discussion of that in a moment. But right now, Professor Abby Joseph Cohen joins us. She is entrenched at the Columbia Business School and, of course, for decades at Goldman Sachs is a partner. Professor, how's it going? What a shift to go from the 25-hour week of Goldman Sachs down to the cushy job as a professor at one of our acclaimed schools. How abrupt has the shift been?
Well, it's 25 hours a day, not a week.
Excuse me, correct.
That's quite all right. It has been a wonderful adjustment for me, frankly. You know, I was an adjunct at Columbia for almost a decade, so I knew what I was getting into. I love the students at Columbia. Half of them are from overseas, and it's a terrific faculty. And I'm spending time with a lot of the faculty working on new curriculum materials for them, incorporating the real world aspects into the academic work.
And the foundation here, folks, is something that's a rite of passage if you're in the racket. You must read either 1934 Graham Dodd, or maybe you catch up with Graham Dodd and Cottle. Right now, we look at Graham Dodd and Joseph Cohen, which is going to be the new definitive book out of Columbia Business School. How do you take the fundamentals that we were weaned on and drag them forward into Jerome Powell's modern age?
Tom, that is a wonderful question, but first let me set the stage. And that is to say, for the last few years, the fundamentals have mattered less than things like momentum and investor enthusiasm. You know, you take a look, for example, at the strong correlation between the technology stocks, cryptocurrency, and so on, and basically say these are types of financial assets in which valuation approaches really didn't matter very much. And I think we're now back into a period in which it does matter, where it's the fundamentals of earnings, the fundamentals of margins, the fundamentals of inflation and interest rates, and putting that all together in terms of appropriate valuation models, that will make a big difference for investors going forward.
Abby, how do you model the fundamentals at a time when people can't game out whether we're going to have a sanguine economy or a hard landing that looks something like a depression? At what point do you game out recessionary outcomes in your fundamental analysis?
Yeah, there are two different ways to look at that, Lisa. First of all, we can game out alternative scenarios. So we have some sense of what the range of possibilities might be, not just for equities, but other financial assets. But of course, at the end of the day, an investor or portfolio manager has to say, what do I think is the most likely scenario? You can always plan for the worst if you have very little risk tolerance. You can always plan for the best if you're highly risk averse. But I think many portfolio managers are aiming for something in the middle where they're trying to identify what is the most likely scenario.
Right.
And as some of your earlier guests indicated, what seems to be priced in right now is a mild recession, certainly not a severe recession.
When you look at the parameters, do you look at the end of the era of free money, or do you look at just simply a pause, a momentary reprieve from the ultra-low rates of more than a decade as we try to curtail inflation, and then a reversion back to that at the end?
Yeah, let me adjust the question just a little bit, Lisa, and to say that money isn't free anymore, but in many cases, it's not particularly expensive, particularly by historical standards. And so while we have seen this rise in interest rates and the Fed is likely to continue to move those short rates higher, we've already seen quite an increase in the intermediates and the longs and the rates that affect consumers, for example, through mortgages. And so what we have to recognize is that when money becomes more expensive, in some ways, investors, households become much more careful with it, because if it's no longer free, you're going to see less leverage, which is a good thing in portfolios. For example, we've had incredible returns in some private equity portfolios. Maybe the basic returns were good, but in some cases they've been turbocharged by significant amounts of leverage, which sort of hide the underlying skill set, if you will, of the portfolio manager. And then, of course, there are many corporations that took advantage of very inexpensive money to leverage up their results. And so when money is no longer free, we get to see a better picture of whether those corporate managers and those portfolio managers are actually doing a good job.
Well, Abby, you talk about how people are more careful with their money in this kind of environment. And we know that it wasn't just, corporations and big institutional investors that were moving money around during the pandemic free money area. You also had stimulus that was fueling the retail investor, and they have been a force within these markets. What happens when that goes away?
What we are looking at, of course, is a situation in which individuals, in many cases, became overly enthusiastic about some areas of the market, equities and elsewhere, including digital currencies, that offered good momentum. And what we are moving into and have already begun to see is what happens when the momentum breaks down and you need to start looking at the valuations per se. Now, individual investors, of course, have many different factors that they need to be concerned about. Some of it has to do with how much longer they have in their investment horizon, what else they might need the capital for, and so on.
Right.
And so we may, in fact, see less money, and we have already seen this, going into things like cap-weighted ETFs. We've not yet seen the intermediate aspect, and I don't think it's going to be all that bad, frankly. Just looking at the demographic.
I say this in great honor of your 2005 paper, which is definitive, folks. It's basically codified within the CFA Institute. Aristotle on investment decision-making. We have dragged ourselves, Professor, from the elegance of 2005 to a 2022 discussion of what's called a cathartic puke. How does catharsis play into fundamental analysis and the confidence to own equities? Do I need to go down substantially to find a base to own equities?
We are now, I believe, Tom, in a situation where beta will be less important than alpha. And that
Explain that, please. That's really important. Explain that.
Investors always think that they are smart in a bull market, right? So if you're invested in a bull market, almost anywhere in a bull market, the beta of the market, and that has to do just with slopes of lines and so on. Don't confuse basically a bull market for genius. And so that's beta. Alpha is security selection. And one of the curious things about the last 2 to 3 years in particular is that it's been really hard to get alpha. So investors, professionals who've used sophisticated approaches trying to identify what particular securities they wanted to invest in often stumbled because alpha didn't matter very much. With this dramatic reset in the markets, the overall decline, number one, number two, the breakdown of the momentum orientation, and number three, the recognition that the economic cycle itself is shifting. We see a move now, I believe, toward alpha, and that's not just within the U.S. equity market. It's likely to happen in other developed markets as well. Yeah. And also think of it more broadly in terms of asset categories that are no longer all going to be moving in lockstep.
Well, that's exactly where I wanted to go, Abby, and we just have about a minute left. Does this mean that it's the end of the sort of standard 60-40 in terms of just working and needing a more nuanced, scalpeled approach, even with asset allocation?
Let's recognize that 30-year plus period in which inflation and interest rates were under good control and continue to move lower is over. That doesn't mean that a year or two from now, inflation will be under incredible uncontrol and interest rates still dramatically rising. I don't expect that. But we are exiting that 30-year period in which fixed income securities were a very good place to be invested, and that 40% rule right now may not be, such a clever thing. One other point, if I may, that Aristotle paper talks about the importance of understanding the data. Let me give you one example right now. There's so much focus on headline CPI. You guys have done a great job of contrasting headline CPI to core CPI. What the Fed is looking at is the better measure, which is core PCE, which is running 3 to 4 percentage points below the headline CPI. So rather than looking at like an 8% number, they're looking at a number which is 5%, maybe a little bit lower. It's still a rise in inflation. I don't mean to suggest not, but it is not quite as awful looking as the headlines would suggest.
Abby Joseph Cohen, thank you so much for joining Bloomberg and Bloomberg Surveillance today at Columbia Business School. Lisa, I think this is the arch debate, and I don't know if Chairman Powell will go mathy on the Senate today, but the idea of the gloom of 9, 8%, whatever it is, and OMG, when do we get back to 2%? Versus, is Professor Joseph Cohen mentions there, the marginal move. Take core, 6.x%, and you come down a little, then you come down a little, then you come down a little. How does that change perception?
Yeah, and how does that factor into active investing and the potential return therein? Yeah. We're going to be talking about that as well as the contours of a recession, what it means, and what's priced in with Tony DeSpirito coming up on the Open. He's Chief Investment Officer for BlackRock, U.S. Fundamental Equity Portfolio Management. This, to me, is really ultimately the question, Tom. Are we looking right now at a recession that might not be so bad or has already been priced in?
Do you see how I got Abby Joseph Cohen to say cathartic puke? I failed, but I tried, Lisa.
Good job. Good job.
I tried.
Get a blue ribbon.
That was interesting. Very, very interesting there. Read Graham Dodd and Cottle. That's all I got to say. It's a rite of passage. Futures deteriorate, -50, now -62 on the Standard & Poor's John Farrow futures. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Bloomberg's learned that President Biden will call on Congress to enact a gasoline tax holiday. The president's expected to make A statement today, average gasoline prices are around $5 a gallon in the U.S., and they typically rise in summer. Federal taxes at 18.4 cents a gallon. It's not clear how long the president wants the tax to be paused. In Afghanistan, at least 920 people have been killed and hundreds more injured in a powerful earthquake. The magnitude 6.1 quake struck the southeastern part of the country overnight. The government has sent helicopters and rescue teams. There's a sign that China's broad crackdown on tech companies such as Ant Group may be easing. President Xi Jinping chaired a meeting today that approved promoting what was called the healthy development of the payment and fintech sector. Beijing has promised to unwind crackdowns that torpedoed Ant's record initial public offering in 2020. The American affiliate of the largest global crypto exchange, Binance, will offer zero-free trading for Bitcoins. Binance US also plans to eliminate the charges for more tokens in the future. That will put pressure on other crypto exchanges like Coinbase to lower their fees. Rents on 1 million apartments in New York City will go up by the most in nearly a decade. A panel approved a 3.25% raise for 1-year leases and 5% for 2 years. That reflects the political promises of Mayor Eric Adams. He's a landlord himself who has signaled strong support for small businesses and property owners. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
A lot's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question. Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
I think it's going to be a relatively mild recession at this point because the financial system looks like it's pretty solid. Household and business balance sheets look like they're pretty solid. You really get a deep downturn when things in the financial system break and the ability to supply credit to people becomes impaired. I don't expect that to happen this time.
Bill Dudley, the former president of the New York Fed, senior advisor for Bloomberg Economics, with a blistering note today on hard landing. It is a required read for Global Wall Street. Lisa put it out on Twitter. I retweeted her retweet of the retweet, and it's out there somewhere. Kaylee Lyons and Tom King. Kaylee in for John Farrow as well. Lisa preparing for the 9 o'clock Farrow property, as they do. Kriti Gupta is here to distill a chart on distillates. Kriti, what do you have?
Yeah, we got to talk about gasoline here, Tom, because we're talking about just how high prices
and
are.
Jerome
in
Powell
the
will
States.
talk about it.
Of course, he will in his testimony today. And this is something that's really becoming a global issue. So for my chart of the day, we don't go to the U.S. gasoline issue. We go to the European gasoline issue, where inflation is higher. And of course, the cost of living crisis is far worse than where it is here in the States. I'm showing you folks a chart of margins here, the gasoline margins relative to Brent crude. And it goes back all the way to 2005 for our radio audience. Really what you need to know is from 2005 to about 2019, it's almost a straight line when you look at the regression, which tells you that there isn't a ton of movement in those refining margins. But then 2020 to 2022, a sharp acceleration, really speaking to that need for that refining capacity, that really record demand that you're seeing. And it's a topic that President Biden has mentioned multiple times as well, as soon or as recently as yesterday, of course, in response to that pretty scathing letter from the Chevron CEO, Mike Wirth. Tom.
Kriti, thank you so much. Greatly appreciate it. We prepare now for Chairman Powell coming up here with headlines, I believe, at 9:30 and then on to his testimony after opening statements. You'll hear that and see that on Bloomberg. We're thrilled to do that for you this morning, but we need a brief, and we need it from where the televisions and radio will be tuned in, and that is 1600 Pennsylvania Avenue. Anne-Marie Horton joining us now, our Bloomberg Washington correspondent. Anne-Marie, what does President Biden need this morning from Jerome Powell?
I think really what you're going to want to see from Jerome Powell is how he's received up on the Hill, right? Like, what's the tone of his reception? Is it going to be very harsh? I mean, you're not going to get a standing ovation, but at the same time, is there going to be some reception that these senators like what the Fed is doing in terms of really wanting to tamp down inflation and becoming much more hawkish on it? Obviously, the questions are going to be about inflation, and then while you're trying to control inflation, how much of a risk does Chair Powell see when it comes to this narrow, really, scope of not going into a U.S. recession?
I mean, the panic's over recession. Abby Joseph Cohen just joining us from Columbia Business School. Anne-Marie making clear this panic is unfounded. We need to look at fundamentals. The fundamental for Chairman Powell, and quite frankly for President Biden, is core inflation. Right. There's glimmers of hope, right?
Glimmers of hope when it comes to core inflation, but at the Fed meeting, what did Mike McKee, our very own colleague, I think he asked the best question, which is, are you going to chase headline inflation, a.k.a. are you going to chase higher oil prices? And Chair Powell said, our mandate is inflation. That's headline inflation. He made pretty clear that Americans do not like high inflation. It's obvious, and you see that every day in things that are part of the headline number, which is gasoline prices.
Right, and that's why it's so political, because the most obvious to the American consumer sign of inflation is when you see that price ticker at your gas station ticking higher and higher and higher. When do the politics of inflation, the problematic politics of inflation for the Democratic Party, turn into politics of unemployment and potentially higher unemployment as a result of the Fed's action to tame inflation?
Well, I think that's something they're struggling with, but they have made clear that they understand that growth is going to be slower, and part of hiking rates and tamping down inflation is going to mean, and we saw this in the Fed forecast, slower growth.
And with you, and I've got to go to Jay Powell in the September 21 meeting, which will be after he gets a can of tomatoes from the Horton family after your August canning of tomatoes. The price of tomatoes, I just did a study, it's up 55%. I mean, it's everywhere, Amory. I mean, whether you're canning tomatoes with Amory Horton or not, inflation is everywhere for Jay Powell.
It's everywhere. It's groceries, gasoline, rent. These are the huge problems. And especially when it comes to groceries, part of this obviously exacerbated by what we're seeing with Russia's invasion of Ukraine. When it comes to crops, that's going to show up especially in the most vulnerable developed parts of the world, places like Egypt that have to have in massive imports. But then at the same time, America is a farm to truck to table economy. We get our groceries through trucks, higher diesel prices, which is why the president today is going to call for a gas tax holiday on gasoline as well as diesel, because that is critical to the U.S. consumer.
And to your good point, I make light of it, but this is no joke, folks. It's about the process of hydrocarbons within our agricultural system. Anne-Marie Horton, thank you so much. And Kaylee Lyons, and I really look for the invite here to the Horton canning of tomatoes in August. Kaylee, can you imagine that? The kitchen must be destroyed.
I just hope I get a can of it, Tom.
Well, that's
how do we know when the can rationing comes?
I don't know.
Is there like a list we sign up on?
You know, we get food gifts from time to time. Maybe we'll get something from Anne-Marie Horton as well. This testimony is not normal. We have to remember, and the headlines came out. I just saw a headline. I do not have it in front of me, of new Canadian inflation back to 1983. Kaylee, I mean, it's hitting every country everywhere.
Yeah, it absolutely is, Tom. It's hitting consumers across the board as they grapple with higher costs for necessities, raising a question of how long they're going to continue to spend on discretionary items. And of course, as the market grapples with inflation, and not just that, but the response mechanism of central banks to it, you are starting to see some real pressure in this market, Tom. Equity is back lower, and I'm looking at the 10-year yield right now, down 11 basis points.
Yeah, seriously.
3.15%.
Yeah, I'm glad you bring it up to 4 digits, down 12 basis points, 3.16%. Matt from Ducati emails in and says, Tom, no crypto chat today. What happened? What should we look for, seriously, Kaylee, in crypto as we touched 19,000 earlier?
Yeah, we got a little taste below 20,000 once again. Tom, crypto right now is just so entirely coordinated with broader risk sentiment. The correlation is very clear. On a day when equities are down, a reversal like today, you are seeing crypto giving it back. It's very hard after all of the conversation talking about it as a potential inflation hedge or a non-correlated asset. That is not how it's been performing as of late.
Here's where we're setting up for global Wall Street this morning with futures at -58. A bit of a deterioration in the last hour. The VIX out of stick now, 31.23 on the VIX. As Kaylee Lyons mentions, 3.16% on the 10-year gets your attention in a big 12 basis points. To see the 2-year break 3% would be a huge deal. We're not there, 3.09% on the 2-year yield. We draw your attention to the testimony of the chairman of the Federal Reserve System, the monetary report to the nation. We will bring complete coverage of that on radio and television, and look for the headlines here in about 35 minutes. Again, futures at -58. Dollar resilient this morning, and the yen that we're watching, the yen 135.85. This is Bloomberg.
prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
From New York City for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Farrow. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
We begin with the big issue, investors bracing for Chair Powell.
The question is also whether the Fed and other central banks will actually be able to raise rates enough.
The Federal Reserve is definitely taking the steps that are needed.
The Federal Reserve is on this.
I'm expecting the Fed to be a bit more hawkish.
I don't think we can get peak hawkishness until we get peak inflation.
This is late, but they will be probably overly aggressive.
If the Fed remains as aggressive, I think those recession risks rise.
We should get prepared for recession pressure.
The Fed has no choice. Keep on tightening, even if that's going to lead to a hard landing.
The bigger question for us is how hard of a landing can the Fed and policy change really create?
And how much does this testimony really matter given all the hawkishness currently being priced into markets and the talk of recession? Joining us now, BlackRock's Tony DeSpirito, Morgan Stanley's Michael Cushman, and Cameron Dawson of New Edge Wealth. Tony, I want to start with you on that. How much does this testimony matter?
Yeah, so, markets have come a long way. I think it's important to recognize that markets are down, 20 to 25% year to date. Multiples have contracted from 22.5 down to 16, basically at historical averages. So I think we're all asking this question of how low can it go? It's like we're playing a game of limbo, but I don't think that's the right question. I think the right question is, should we be dollar cost averaging in? I do think that's a prudent way to act, and I think that's true regardless of Fed testimony today.
All right, so Cameron, to that point, is that something that you're looking past in terms of what the hawkishness is of the Fed and the data dependency into something more fundamental and detached from the Fed?
Well, I think we have to acknowledge that Fed tightening really does put downward pressure on multiples. And we don't think that we can see a bottom in this market until liquidity is getting incrementally more abundant than more incrementally scarce. And we're in this world where Fed tightening is causing liquidity to become more scarce, putting downward pressure on multiples. But the problem is on the fundamental side, We haven't seen analysts cut estimates. We still have $230 a share for EPS in 2022. That's 10.5% growth. There's 9.5% growth in 23 and 24. So we really don't think that we've priced in a dire scenario at all at this point.
Meanwhile, Michael, I'd love your sense of Evercore and their comments ahead of Chair Powell's test high inflation and worry that political pressure could add to the backward-looking element of Fed policymaking that invites recession risk. Is that what you're expecting, a very hawkish tone, Michael, that could prompt perhaps more selling at a time when we're actually seeing a bid to bonds?
Well, it's only been a week or so since the last meeting, so I don't think you can deviate too far from what he previously talked about, but I do think on the back of that meeting last week, he will emphasize the Fed is on the case. The Fed wants to tighten not just to neutral by the end of the year. Now it's getting to a restrictive stance by the end of the year. We're talking about 3.5%. Fed funds rate just wasn't too long ago. We were talking about back in March, 2.5%, 2.25% Fed funds rate. So he is moving expeditiously, not just to neutral, but to tighten and to make the case that they're working on it. Make the case that we can do another 75 in July, and we'll keep going until inflation starts to come down. And by moving aggressively now, gives them more room to maneuver, to judge what's happening at that time at the end of the year, to give them freedom of maneuver, and to prevent them from going too far. So more they do now, the tougher they are now, the less likely they will overdo it cumulatively.
And that was what Bill Dudley was saying earlier this morning. Futures firmly in the red ahead of that meeting. Havens catching a bid as they prepare for Chair Powell's testimony in front of the congressional panels today and tomorrow, coming up later this hour in front of the Senate. Let's bring in Taylor Riggs for a look at the price action. Taylor.
Yeah, Lisa, really interesting. We've had a good, strong few days here, of course, of a big rally, and a little bit of that, of course, unwinding this morning within the futures market, within the equity markets, and you certainly see that. I think what is so interesting, and Sherry Paul, portfolio manager over at Morgan Stanley Private Wealth Management yesterday, was telling us that correlations are actually finally coming back in play. In the last few days, when you had a good equity market rally, bonds were selling off. Now that equities are coming down just a little bit, 1.5% or so, you change up the board and bonds are actually catching a bid. Huge moves here within anywhere from maybe 10 to 15 basis points across the curve. Within really globally, I, of course, am ever so focused here within sort of the 10-year yield that you see there. So maybe the 60-40 hasn't been so bad when you rarely think about in the last few days those correlations. Of course, as we know, you've mentioned Jay Powell. For me, really, since that meeting last Wednesday, all the focus has been really on the front end of the curve, since that is so sensitive to any of those comments. I think it's interesting. In the last 2 weeks, Lisa, we've really been stuck between maybe a 3.4% or so in the 2-year yield. So we're really range bound if you take a look at that 2-year yield within the last 2-week period, trying to find perhaps maybe where that might settle out at.
Taylor Riggs, thank you so much. Talking about recession, Citigroup's Nathan Sheets seeing the probability of a global recession nearing 50% rating. Quote, history indicates that disinflation often carries meaningful costs for growth. Central banks may yet engineer the soft or softish landings embodied in the forecasts, but this will require supply shocks to ebb and demand to remain resilient. Tony, how do you play offense when there are these exogenous risks that need to really work themselves out in order to determine the scope of whatever the potential recession could be?
Sure. I mean, we're definitely facing a fork in the road. If the Fed tightens too much, obviously there's the risk of recession. If it tightens too little, there's the risk that inflation expectations spiral upwards. And the challenge for investors is the portfolio you want to own, the optimal portfolio in each of those scenarios is very different. So what I've been advocating is a barbell approach. On one hand, have the inflation fighters in your portfolio, sectors like energy, like financials that have historically done very well during inflationary periods, but balance that out with some of the resilient recession-proof sectors. And for me, my favorite sector there, far and away, is healthcare. If you look at the other go-to sectors, staples and utilities, they've been bid up sharply and have premium multiples to the market, whereas healthcare, which is just as recession resilient, actually has a below market multiple. And so that's how I've been tilting the portfolios I run, is we have this barbell, tilting that barbell incrementally towards resiliency.
Resiliency is something that PIMCO's team sees in bonds, writing, quote, "There are relatively defensive areas of fixed income markets that are now offering more attractive yields than we have seen in some time. That's helped to increase both potential income and the margin for error for investors." Michael Kushma, is this where you're finding a defensive play as well, or perhaps offense because of the yield that you're getting?
Well, there's no doubt that yields are substantially more attractive than they were 3 months ago, and certainly longer ago than that, giving you a lot more protection in case yields move higher again, in case inflation doesn't come down as much as expected, in case the Fed tightens monetary policy further than expected. So in all cases, that's more attractive in terms of risk-free treasury yields. But in addition to that, credit spreads are much wider now, especially in terms of higher quality assets. Investment grade corporate bonds now are yielding 50, 60, 70 basis points higher, wider spreads versus treasuries relative to the beginning of the year. So now you're talking about buying investment grade bonds that could yield 4 to 5%, which is a pretty healthy yield if inflation does come down to more normal levels in the next several months.
So, Michael, are you going more into risk or more into investment grade?
I would say higher quality assets, upgrading credit quality. It's a tough call right now because it's we're kind of priced this no man's land between, is recession or inflation the bigger risk? If inflation turns out to be the bigger risk, and in recession the economy turns out to be resilient, and if recession doesn't really come around, inflation's not going to fall probably as much as the Fed wants, and up go interest rates, and that is bad for more higher quality bonds. On the other hand, if recession does materialize, then higher quality assets will outperform, and we'll get that negative correlation between risk-free assets or low-risk assets and equities and riskier assets, where you don't want to own high yield or maybe equities in general. So right now, with the investment grade market pricing in a reasonable high probability of recession, which we still think is less than 50-50, those bonds are looking a lot more attractive right now because you are getting a decent risk premium relative to expectations, likely probabilities of recession.
Wells Fargo's Winnie Caesar is seeing some breathing room for the Fed when it comes to credit. Take a listen.
The Fed is very focused on whether or not capital is flowing into the credit markets. What we've seen is issuers are able to come to market and price deals. Now, these are at much higher coupons or borrowing costs than last year, but deals are still getting priced fairly efficiently. Most issuers have done a really good job of pushing out maturities, of locking in really low coupon debt last year, and that gives the Fed a little bit more air cover to continue to tighten policy.
And this lack of credit market dysfunction, Cameron, is what's giving a lot of people confidence to go in and invest in some of these instruments at yields that they have not seen going back to 2009. Where are you seeing the most value? Is credit emerging as a sweet spot, or is it really mostly in the equity and then the full faith in credit debt markets?
Well, I think we have to be careful in saying that credit's going to remain resilient from here, because the reality is that the Fed is still technically rather accommodative, because we're still below neutral at their 2.5% of neutral, and the balance sheet is still growing 10% year over year. Now, eventually it will start to contract because of quantitative tightening, but we really haven't seen the kind of tighter policy yet that would cause shock waves through the credit market. So it could be that when we get to the actual application of this tighter policy later into the fall, it will be an interesting scenario how we see credit markets hold up, because at that point, the Fed may have to choose between supporting credit markets, keeping them open and functioning, and fighting inflation. And we think that could be quite a pickle.
Cameron Dawson, Tony DeSpirito, and Michael Kushma, all of you are sticking with us. We want to take a look right now at the stocks moving ahead of the opening bell. Here is our very own Abigail Doolittle. Abigail.
Well, Lisa, ahead of Fed Chair Jay Powell's prepared comments and that testimony to Senate, we, of course, have a risk-off tone here. Investors rethinking yesterday's bullish tone as stocks sell off and bonds rally. Apple down 1.4%. Even though yields are in, investors not looking are looking past that and not really caring. Now, a big piece of this, as you know, oil. Oil breaking down closer to $100 per barrel, below its 50-day moving average, a fancy way of saying that the near-term buyers, they're out. So let's see where support comes in, but that's really hitting the energy complex. We also have a broad-based sell-off here. General Motors down 2.1%. And of course, a reminder here, this recessionary fear, demand for cars is waning. And then rounding it out, banks down 2.3%. This, of course, with yields. It's interesting, though, Lisa, we do here have headlines from Patrick Harker saying that the data is coming in, and that's exactly what they want. It's going to be very interesting to see, of course, what Fed Chair Jay Powell does say. But right now, investors are a little bit on edge ahead of those comments.
Abigail, thank you so much. And we will be taking those comments live when they come out later in the hour. Coming up, all hands on deck, President Biden calling on Congress and big oil to tame surging gasoline prices.
We ought to be able to work something out whereby they're able to increase refining capacity and still not give up on transitioning to renewable energy. They're both within the realm of possibility.
That conversation coming up next. For now, we are looking at a risk-off environment. 1.5% decline on the S&P ahead of the open here in about 17 minutes. We see a bid into bonds as the 10-year Treasury yield goes down about 10 basis points. From New York, this is Bloomberg.
About what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now. We are dying slowly but surely, and our lifespan is reducing every day.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
We can stabilize the energy market. I believe when the Fed does their job, we'll have inflation under control. If we don't, we have a big problem.
President Biden delivering remarks from the White House at 2 p.m., announcing he wants Congress to ease America's pain at the pump by enacting a gas tax holiday. However, there's a lot of pushback, including from former White House economic advisor Jason Furman, who warned the move could actually backfire, tweeting, quote, "Whatever you thought of the merits of a gas tax holiday in February, it's a worse idea now. Refineries are even more constrained, so supply is nearly fully inelastic. Most of the 18.4-cent reduction would be pocketed by industry, with maybe a few cents passed on to consumers." Joining us now to discuss, Bloomberg's Anne-Marie Hordern in Washington, D.C. You've been talking all morning how this is political theater. It is dead in the water. It is not going to get passed. Anne-Marie, what is he hoping to accomplish at 2 p.m. today when he comes out and announces it?
So first, Lisa, as you say, this is political theater because we do know from what we've heard for months from Congress, including Democratic leaders like Speaker Pelosi, that they are not on board with a gas tax holiday. Speaker Pelosi has called this showbiz, basically saying that this is something that sounds nice, but her concerns especially are that does this actually get passed on to the consumer? So on one hand, the president cannot just act alone. He's just asking Congress to act, and it doesn't look like there's any appetite on Capitol Hill to do that. What the president is going to try to do, and what the White House wants to be seen as doing, is taking action on any fronts, pulling any lever they can to ease these concerns of American consumers. And one of the biggest concerns we know is gasoline prices, especially ahead of the July 4th holiday.
And Maria Hordern in D.C., thank you so much. And throughout the day, I'm sure we'll be catching up with you to get updates as we hear more. Still with us, we are so lucky to have Tony DeSpirito, Michael Kushma, and Cameron Dawson. I do want to know, Michael, whether we've moved into a regime where suddenly the negativity around the economic forecasts are turning into a bearish tilt for oil rather than a bullish one as an inflation hedge.
It's a very good question. There's demand and supply issues, and it's a complicated world where, as we've talked about, refining issues in terms of the ability to refine crude oil that's being produced. I don't have a clear view as to how this supply-demand interaction is going to work out, how much of the rise in prices is going to destroy demand for oil or gas, as well as other goods and services. It does seem to be having some impact. So right now, I'm fairly agnostic about how oil is going to be in the next several months.
Cameron, what's your view?
Yeah, so we haven't actually seen driving miles get hit yet because of higher oil prices. You would think, given gas prices have surged to all-time highs, that you'd see people driving less. It isn't showing up yet, but there is a point of demand destruction. That's clearly what's being priced into oil markets today. And if we think of the consumer overall, it's not just about oil. It's about food, and it's about rent. And if you add those three up, that reaches almost 50% of wages. So as we see all those three components move higher, we think that the end result is that consumers have to tighten their belts in many places, mostly on discretionary purchases, which is what you started to hear from companies the last earnings cycle, where they were saying that people really were doing that belt tightening.
Well, Cameron, and we'll get back to what some of the ripple out effects are, but Tony, I'd love your call in terms of oil companies, oil majors, stocks. As the inflation hedge that has been as popular as it has been, is it time to start fading that? Because at this point, a recessionary call will be negative for the oil complex.
So we've been long energy stocks since summer of 2020, and we continue to be long, although we've been harvesting some gains. So we've been reducing that long position, but still long. And here's why. And it's about supply demand, and supply is incredibly constrained. Obviously, the war in the Ukraine is part of that, but it goes way beyond that, right? Oil companies have been restrictive on capital spending since 2014. That's a long time to be restrictive, and we're seeing the effects of that. Your question on the demand side is spot on. There is that risk that if we slow down, that will slow down demand, and that will move oil prices downward. But you got to remember, right now, oil prices are artificially low because we're selling from the Strategic Petroleum Reserve. That ends in December. So that's good for longer-term oil prices. Plus, when you look at the stock prices, they're not discounting $100 oil. They're discounting more like $60 oil. And that's the margin of safety, and that's why we're still long the sector.
Okay, so you're still long. Tony, I want to get this straight, but you've been reducing the long. What will make you reduce it further, and where are you putting the proceeds?
Yeah, so one of the things we've been doing in terms of proceeds has been putting more of that money in healthcare. As I discussed earlier, I do think it's a highly recession-resistant sector that's still very attractively priced. We've also been adding on the margin to some consumer discretionary stocks because they're already discounting a recession. And so I view that as a very positive margin of safety for consumer discretionary stocks. So that's how we've been playing it. You know, where we go from here just depends on stock prices, and that's how we play it.
Cameron, from your perspective, especially given some of the pressures on the consumer balance sheet, do you agree that the consumer discretionary group has been discounted to such degree that you can even go into those despite some of these pressures?
Well, if we look at the EPS estimates for consumer discretionary, they have come down significantly, but they're still pretty high. They've gone from 45% growth at the start of this year to 23% expected for 2022. So that doesn't feel recessionary yet. Certainly valuations have come in further. So we think you have to be very selective. And we have been finding opportunities in some more of those higher quality areas of consumer discretionary that are now trading at reasonable prices. So you look for good business models that have pricing power. You look for strong return on invested capital, free cash flows being very strong, but you have to be extremely selective because also a lot of these names are in downtrends. So, we want to be very careful that we're not just buying into relief rallies.
Michael, final word here. I do wonder where you start to see value, particularly on the long end, considering how much things have gotten bid up. Where are you hiding out? And will the relationship, the inverse relationship, reassert itself between bonds and stocks?
It's a very good question. It really comes down to this inflation versus recession risk. If inflation is the number one worry, then the curve gets more flatter, inverted because of the higher pressure on short-term interest rates, and the Fed may be having to go even tighter monetary policy next year. Where monetary policy is not expected to get very tight as measured by expected real interest rates if inflation doesn't come down pretty quickly. On the other hand, if the economy does weaken and move into recession, the curve's going to steepen. The Fed's going to achieve its objectives. Inflation's going to come down meaningfully, maybe according to its projections that it just came out with, and getting well below 3% by the end of next year, and closer to target in 24. Things look pretty good. Yield curve steepen. Right now, we're playing it fairly cautiously by looking at where's the peak in the yield curve. So you look at the 3 to 5 year part of the yield curve, looking at investment grade assets, securitized credit, asset-backed securities, things that are still maybe floating rate note, where you can get, again, reasonably attractive yields in that 4 to 6% range, depending upon how much credit risk you're taking. And that looks like a decent rate of return right now. The other area is inflation-protected securities, where we have positive real yields for the first time in a long time, where you're still protected by inflation, but you're actually getting a positive real yield. The danger there that the Fed pushes real rates up even higher to control inflation.
Michael Kushma, Tony DeSpirito, and Cameron Dawson, all of you are sticking with us. Coming up, the morning calls, and later, Fed Chair Jerome Powell testifying on Capitol Hill, reporting to lawmakers the state of the U.S. economy and the fight against record inflation. From New York, this is Bloomberg.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
In crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Time now for our morning calls. A look at some of the analyst recommendations in Wall Street this morning. First up, BMO upgrading Kraft Heinz to outperform, expecting the company to overcome inflationary headwinds. Next up, RBC downgrading Pulte Group to sector pointing to weakening housing demand. And finally, Credit Suisse downgrading Dow Inc. to underperform, forecasting a slowdown in consumer purchases. Coming up, countdown to the Fed. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Just about 30 seconds, countdown to the open. I'm Lisa Abramowitz in for Jonathan Farrow. Moments away from the start of trading, also from Chair Powell's testimony on Capitol Hill. Taking a look at what we're seeing in markets right now, clawing back some of the losses from earlier. The NASDAQ now down less than 1%. S&P down just a little over 1%. We can see a rally into the bond market as people really start to look at that inverse relationship. We do have some headlines. Let's get them from Bloomberg's own Michael McKee in Washington, D.C.
Well, Chairman Jay Powell is set to speak before the Senate Banking Committee momentarily, and there's nothing new in his prepared remarks, at least that investors will care about. It's a bit of a sales job, stressing the Fed is well aware of the hardships that higher inflation brings. Stop me if you've heard this before, but they are strongly committed to bringing inflation back down, and we are moving expeditiously to do so. But the chairman does not explain what expeditiously means. There is no mention of possible future rate hike sizes in the text, only that they will be appropriate. In coming months, Powell will say Fed officials will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. Quote, we anticipate that ongoing rate increases will be appropriate. The pace of those changes will continue to depend on the incoming data and the evolving outlook for the economy. They will make their rate decisions on a meeting-by-meeting basis, he says, and they will continue to follow the data to see where it leads them. He does not mention or discuss the possibility of recession, but he does say the American economy is very strong and well-positioned to handle tighter monetary policy. Perhaps anticipating some criticism from the senators, Powell does note that, quote, making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. Now, there will be criticism. Several Republican senators have put out statements that they will repeat in the hearing that say, essentially, why is the central bank so far behind the curve? Why didn't they start raising rates sooner? And Committee Chairman Sherrod Brown has a lengthy opening statement decrying what he calls American greed as Russia and OPEC drive up prices and, quote, American energy companies engage in wartime profiteering. This, of course, Lisa, is not the purview of the Fed. Powell will probably duck commenting on that, but no doubt he will be asked about a number of fiscal responses to inflation, including this new proposed gas tax suspension.
Michael McKee, thank you so much with the institutional knowledge of all of the things that we've heard before and what to likely expect, although I do wonder what Chair Powell will say in response to any questions about when he hopes to achieve that 2% inflation rate and how quickly he needs to see the U.S. markets get there. For a look now at how the bond market's reacting, here's Taylor Riggs. Taylor.
And a little bit of movement, Lisa. We were down to about a 315 on the 10-year, off about 12, 13 basis points. That comes up a little bit now, about a 317. So as you can see, there we're off sort of the deep lows of the session when you think about bond price higher, yield lower. I want to fold that into some movement a little bit that we've had in dollar strength. We came into this session, there was a little bit of weakness given the huge sort of dollar strength in the last few months. Some of that was weakness in this morning. A little bit of that continues, as you can see on the screen, mostly unch on the day. Don't want to make too much of it, but certainly trying to find its footing. If you change at the board again, a huge interesting story, Lisa, has been with the big nominal move higher. A lot of this was due to real yields and not necessarily break-evens, and that's what you see there in the white screen has been sort of the stabilization of the break-evens, as you see with the move in the dollar, as a big part of that nominal move has come from the real yield portion and the tightening of the financial conditions more so than some of those inflation expectations. Finally, you change with board, and I think McKee spoke to this when he thinks about the health of the consumer and why you're not hearing big comments about a recession from Chair Jay Powell. A lot of this has been, well, this is the money market funds. This is the stimulus payments. This is the health of the consumer on their individual balance sheet and a huge run up that they have had from those stimulus payments. And maybe there still is a lot of that cushion still to come.
All right. Taylor Riggs, thank you so much. Bloomberg's Abigail Doolittle joining us now, taking a look at the reaction in equity markets ahead of the testimony. Abby.
Well, it is certainly interesting, Lisa, because it seems that investors are somewhat reassured, at least by the prepared comments, that there's nothing overly hawkish there. Ben Emmons over at Medley Capital is saying that Fed Chair Jay Powell really needs to strike the tone between the inflation fight and not something too hawkish. Right now, that stock investors seem to think that that is the case, with the S&P 500 E-mini futures well off their almost 2% lows earlier in this session. And the interesting thing, Lisa, is since the Fed meeting last week, the S&P 500 basically flat. Now, it's been a roller coaster ride between the Powell pop on Wednesday, then giving it back last week. But right now, with futures, again, off of the lows, right now down about 0.9%. Earlier, down more closer to 2%. The NASDAQ 100 coming in even more in a positive way, down just 0.7%. Of course, being helped out by yield. That 2-year yield, as you can see, coming in 11 basis points. So that takes off some valuation concerns and the idea that everything is more expensive. But the one thing that's so interesting, Lisa, and you were really honing in on it earlier, oil down 6.5%, closer to $100 per barrel, breaking some key levels of support. The question is that demand or inflation? Which way is going to win? I would suggest that the $100 mark is going to be the divider. And then relative to sectors, you can see that tech is under pressure right now, down 1.2%, even though yields are down. Let's see how that shakes out as the day goes on. And then, of course, we have some of the other sectors also. Right there, we have auto is flipping slightly higher. Interesting, because that, of course, is a recession tell. And then gas and exploration, energy down sharply with energy.
Abigail, thank you so much. Just to recap what we're seeing out of Jay Powell ahead of the testimony in prepared remarks, something that we've heard before, basically saying the U.S. economy is very strong and it can handle tighter policy. We have heard this before from Fed Chair Jay Powell. Also, the ongoing hikes are appropriate, although the decisions are meeting by meeting. And here is the key commentary. Again, we've heard it before, but to me, this raises some questions. Jay Powell saying the Fed's strongly committed to returning inflation to 2%. The question is when? How long do they need to see this take before they get there at a time when inflation is running north of 8%? We are currently looking at that Senate committee ahead of Fed Chair Jay Powell taking the helm and giving his testimony and then answering questions from members of the committee. Still with us, we were very glad to say Tony DeSpirito, Michael Kushma, and Cameron Dawson. Michael, what's your view in terms of getting back to 2% and how much vagueness there is baked in about how long it needs to take?
Well, I think it is going to take a while, because we do know from last year when everyone was optimistic that inflation would, well, most people were optimistic, including the market, that inflation would be back to 2% pretty quickly, because the majority of the inflation shock was COVID related. And as supply channels re-engaged and as COVID became less of an issue going forward, inflation would naturally fall off quite rapidly. But demand has been also very, very strong, and the supply channels have not improved. So the Fed has two issues. One is the supply side of things. It can't order more oil to be produced. It can't order more oil to be refined, but it can reduce demand. The question is, you can't affect the supply side part of inflation, but you can't affect the demand side. So we need to slow demand down, which will bring inflation down, but it can't affect the other level too dramatically, so that it's going to take time. So there are projections, which they came out with last week, of this gradual trend downward inflation looks to me very reasonable, such that at the end of 2024, inflation is still above their target, but it's a step down function over time. There's no need to get it down faster than that to the 2% target, given the part of inflation which is out of their control.
Tony, given that, there is this belief that the Fed is not going to pull a Volcker, that Jay Powell is not going to raise rates in the same kind of punitive way as back in the 1970s and 80s. Do you agree, or do you think that this sounds like someone who is ready to go hard?
Yeah, I agree. I don't think we're going to have a Volcker moment. I think there are two questions. One is, when do we reach peak inflation? And then two is, where does inflation end up? And I do think that we're closing in on peak inflation. And when inflation starts to roll over, that'll allow the Fed to slow down. I think that'll be a critical moment for markets. But on the flip side, where does inflation get to? I think we're going to have to learn to live with a higher rate of inflation. There have been some huge deflationary forces over the last 40 years, notably the industrialization of China and entry into the world market. Well, that's largely run its course. China's workforce is now shrinking. And of course, there's been a huge amount of talk about building more resilient supply chains, whether because of the trade war, COVID, or now the war in the Ukraine. We're seeing the importance of building more resiliency into supply chains. And it's not going to be fast, but we're slowly starting to see reshoring of supply chains. And then finally, there's decarbonization. We are moving towards a lower carbon world. That, in the near to intermediate term, is going to be inflationary. All that tells me it's going to be hard for us to get to 2%. And so I think the Fed ultimately is going to have to reach a trade-off where we learn to live with higher inflation.
And this is the Adam Posen 3% steady inflation kind of perspective here. But Tony, just to follow up, I mean, how much is this a permanently inflationary view, and how much is this a margin compression view, as a lot of companies deploy capital to adapt to some of these new realities?
Yeah, I don't see the margin shrinkage case, really. Companies have universally reported strong pricing power, that consumers are accepting higher prices. We're seeing it in the inflation data. And so I think corporate margins will continue to be pretty resilient. It'll just be that more of a 3% or so inflation as opposed to the 2 or under that we've seen for much of the last decade.
Cameron, do you agree that we're going to see something more akin to a 3% inflation over a steady period of time, which could potentially reset the valuation perspective for bonds?
Yeah, it's really interesting that we've seen that five-year forward inflation expectations stay so subdued during this entire inflation spell. And I think that the reality of inflation sticking around above the Fed's 2% target is a very possible one, because if you look at the inflation data now, it's very broad and it's very sticky, meaning on the broad side, a lot of components of the inflation index are now very elevated. 80% of them are above 4%. This is no longer just a handful of COVID-related shocks. This is contagion. And then on the sticky side, you see that sticky CPI at a 30-year high. That does not respond to tighter policy very quickly. It doesn't roll over quickly. And so the reality is that even if we see the peak in year-over-year core CPI, it's likely not enough for the Fed to call the all clear, because they are concerned of inflation expectations becoming unhinged.
Tony DeSpirito, Michael Kushba, and Cameron Dawson, all of you, thank you so much for being with us on a day where people are trying to distill how bad things are going to get at a time when things are still pretty good, at least when you take a look at consumer balance sheets. We are just moments away from Chair Powell's testimony on Capitol Hill. Michael McKee down in D.C. tracking all of the action as we hear from Senator Tillis ahead of Fed Chair Powell taking the seat. Mike, how much have we heard from this Federal Reserve about how quickly it will have to take to get back down to a 2% inflation rate?
Well, we've heard that they will get into the 2s at the end of next year. That's from the latest summary of economic projections. They see 2.7% on the PCE, of course, not the CPI, by the end of next year. That seems unrealistic to an awful lot of economists. And I think that one of the questions today that will likely come up is exactly that. When do you think you can get it down near 2%, and what's it going to take to get there? I think the phrase you just used would make an excellent question today. How bad is it going to get?
Mike, there's also an issue as we look out on a Fed that is questioning whether they're going to pull a Volcker about whether they're going to be okay with unemployment ticking up to that 5% level that we saw Larry Summers put out there. Have they talked about the unemployment rate they would tolerate as they try to shift to a lower inflation mode?
Well, you know, at his press conference last week, Jay Powell was asked about that, and he said maybe 4.1% would be an acceptable level. Now, there's not a lot of difference between that and 5% when you consider the total number of people who are employed in the United States. So, and they certainly can't predict with precision. So that's probably in the ballpark, and it may not be as outrageous as it sounded when it came from Larry Summers. The Fed is just going to have to live with some higher inflation. What we don't know is what the natural rate of unemployment is. Everybody agrees, including the Fed, that we're below it now. But where is it, and how fast would you go up if you started to raise rates at a much quicker pace?
There was a question this morning about what inflation rate matters, whether it's core PCE, which is the traditional Fed measure, and how much they're going to try to double down on that, stripping out energy, stripping out food, some of these other variables, and whether headline inflation, the CPI, starts to matter all that much more based on inflation expectations ticking upward. Mike, what's your sense of that? We did hear from Fed Chair Jay Powell on this point last week.
Yeah, I think you put your finger on it. It is the headline CPI figure that gets in the newspapers, and that's what people think about, because their experience with higher inflation is on a day-to-day basis with food and with gasoline, and those prices are up and have been going up. And as long as that happens, then that starts to feed into the expectation that inflation will continue to rise, and then you get the possibility of a wage price spiral. For the Fed, it's the core PCE that they watch, because those are the things that they can affect, that will respond to higher interest rates as the economy and demand slows. But that, as Jay Powell says, is a little too technical for the average person.
And as we wait here for Fed Chair Powell to take the helm here, we are seeing a bit of a clawing back of some of the earlier losses. The NASDAQ down now just 0.6%, S&P down 0.7%, 37.43. And we have seen a bid into bonds even at the front end, even after Fed Chair Jay Powell reiterated his commitment to getting inflation down to 2%. That 2-year yield's near that 3% threshold, which is still high compared to where it used to be. How much? And it continues to go down as some of the words that Powell put out there are parsed through. Mike, how surprising is this to you at a time when the Fed is saying we're going to raise rates very quickly, even though there are these risks of a recession?
Well, it's kind of hard to analyze what happens in the markets on a minute-to-minute basis because so much influences what's going on there. But in general, there seems to be a view that the Fed is going to raise rates, so we've pushed up our floor. But we are going to go into recession, or the economy is going to slow, and that will bring inflation down. So we see a bit of a sell-off. Now, the interesting question is how far ahead does the market look? Do they think it's going to take for the demand in the economy to slow enough that supply can rationalize and inflation comes down? And that seems to be something even investors don't know, because we get these swings back and forth, a lot of volatility.
Yeah, a lot of volatility, especially in the currency space, at least when you take a look at the yen. It's been yen weakness, dollar strength. Today, early in the morning, it was very much dollar strength, and now it has actually weakened just a touch. Mike, how important is the dollar right now to a Federal Reserve with an eye toward the international picture and the implications and the pain that some of the developing world feels as the dollar is ascendant?
Well, it's an interesting question because the Fed is, of course, concerned about any kind of blowback to the United States from financial conditions overseas. And given that inflation is affecting the whole world, and given that supply chains are disrupted the world over, falling growth in other countries is going to be bad news for the United States. Much worse news for them, though. And the fact that we have a stronger dollar means we're importing cheaper inflation, a little bit of disinflation because the goods we're buying are less expensive. But it all kind of fits together, and the Fed can't do much about what happens to other countries, so they have to overlook what is going on with the dollar and not try to manipulate it, and they will tell you that straight out. But it does factor into their thinking and their modeling of what could happen to the U.S. economy going forward.
We are listening to Senator Tom Tillis, or that's what we're watching in the backdrop as Mike and I are parsing through some of the backdrop here. And we've heard from Sherrod Brown, Senator Sherrod Brown, really blasting some of the policies and companies for moving jobs overseas. Very much a political type of environment here. It will not be necessarily purely about monetary policy. Fed Chair Jay Powell ascending as we wait here. He is going to deliver his opening remarks. He has taken the helm. Let's take a listen to what he has to say.
Senator Tillis and other members of the committee, I appreciate the opportunity to present the Fed's semi-annual monetary policy report. I'll begin with one overarching message. At the Fed, we understand the hardship that high inflation is causing. We are strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve it will take to restore price stability on behalf of American families and businesses. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. I will review the current economic situation before turning to monetary policy. Inflation remains well above our longer-run goal of 2%. Over the 12 months ended in April, total PCE prices, that's personal consumption expenditures prices, rose 6.3%. Excluding the volatile food and energy categories, core PCE prices rose 4.9%. The available data for May suggests that the core measure likely held at that pace or eased slightly last month. Aggregate demand is strong, supply constraints have been larger and longer lasting than anticipated, and price pressures have spread to a broad range of goods and services. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is boosting prices for gasoline and fuel and is creating additional upward pressure on inflation. And COVID-19 related lockdowns in China are likely to exacerbate ongoing supply chain disruptions. Over the past year, inflation also increased rapidly in many foreign economies, as discussed in a box in the June Monetary Policy Report. Overall economic activity edged down in the first quarter as unusually sharp swings in inventories and net exports more than offset continued strong underlying demand. Recent indicators suggest that real GDP growth has picked up this quarter, with consumption spending remaining strong. In contrast, growth in business fixed investment appears to be slowing and activity in the housing sector looks to be softening, in part reflecting higher mortgage rates. The tightening in financial conditions that we've seen in recent months should continue to temper growth and help bring demand into better balance with supply. The labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies at historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 408,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. A box in the June Monetary Policy Report discusses developments in employment and earnings across all major demographic groups. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation poses significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. With inflation well above our longer run goal of 2% and an extremely tight labor market, we raised the target range for the federal funds rate at each of our past 3 meetings, resulting in a 1.5 percentage point increase in the target range so far this year. The committee reiterated that it anticipates that ongoing increases in the target range will be appropriate. In May, we announced plans for reducing the size of our balance sheet, and shortly thereafter began the process of significantly reducing our securities holdings. Financial conditions have been tightening since last fall and have now tightened significantly, reflecting both policy actions that we have already taken, as well as anticipated actions. Over coming months, we'll be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing rate increases will be appropriate. The pace of those changes will continue to depend on the incoming data and the evolving outlook for the economy. We will make our decisions meeting by meeting, and will continue to communicate our thinking as clearly as possible. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty in what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you very much, Mr. Chairman. Let me, on behalf of Chairman Brown, recognize Senator Warren.
Thank you, Acting Chairman. I appreciate the help of the Chairman this morning, and thank you for being with us, Chair Powell. So Americans are struggling with rising costs, and all eyes turn to the Fed. Last week, you announced that the Fed would raise rates by 0.75 percentage point, the biggest increase in nearly 30 years. So let's talk about what the Fed is and isn't doing when it raises interest rates to try to bring down inflation. Let's start with gas prices. The price of gas is up 40% since Russia invaded Ukraine in February. Chair Powell, will gas prices go down as a result of your interest rate increase?
I would not think so, no.
Okay. that matters because gas prices are one of the single biggest drivers of inflation. Energy prices overall drove a third of the inflation last month, but the Fed's tools, as you say, have no impact here. So let's look at another necessity, food. Price of groceries is up nearly 12% this year. Americans feel the pinch. No matter how much groceries cost, people still got to eat. Chair Powell, will the Fed's interest rate increases bring food prices down for families?
No, I wouldn't say so, no.
Okay. So a Fed increase won't bring down these prices. And why? Because rate hikes won't make Vladimir Putin turn his tanks around and leave Ukraine. Rate hikes won't break up monopolies. Rate hikes won't straighten out the supply chain or speed up ships or stop a virus that is still causing lockdowns in some parts of the world. So let's talk about what interest rate increases can do. Chair Powell, you said last week that interest rate increases, quote, moderate demand. Can you just explain a little more about what that means?
Sure. So we think about interest rate increases as affecting financial conditions and then the economy through three broad channels, the first of which is interest-sensitive spending. So that's durable goods and automobiles and things like that. So interest rates go up. People's demand for, as a result of higher interest rates, will moderate or decline so that supply and demand can get into better balance. The second channel is just asset prices generally. Interest rates, as they go up, will cause asset prices to moderate across the economy, and people spend a little bit less out of their lower level of wealth. The third channel is the exchange rate, which is really just another asset price, and that just basically as the dollar strengthens. As rates go up, the dollar would strengthen, which would tend to drive.
So I appreciate this, and I do appreciate the explanation, but let me just see if I can just put a little more plain vanilla explanation of what's going on here. If I understand what you've said and what economists are saying across the board is that when you raise interest rate, there's going to be less money to invest. And that is, it's going to dampen business investment. Is that a fair statement?
I think the idea is to
makes it more
moderate demand
to invest
so that it can be in better balance with supply. And
so
the current
it's going to make it more,
demand is well in excess of supply in some areas of our
more expensive to invest, which in turn is going to throw workers out of work. And when they're out of work, they have less money to spend. So I get that rate increases stop companies from spending money to build new plants or to buy new trucks or to hire new people, right, Chair Powell? When money's more expensive, they're less inclined to do that. I think that's what you just said on asset pricing, right?
Well, in the labor market, you have, as you know, you have a situation where there's a shortage of workers, and there are two job vacancies for every person who's actively looking for work. So part of this is to get the labor market back into balance.
Well, I appreciate you call it back into balance. What I'm trying to get at, though, is what does the tool of raising rates do? And part of what you just said is that it increases, in effect, the cost to invest, to buy those trucks or new plants or to hire new people. The reason I raise this and the reason I'm so concerned about this is rate increases make it more likely that companies will fire people and slash hours to shrink wage costs. Rate increases also make it more expensive for families to do things like borrow money for a house. And so far, the cost this year of a mortgage has already doubled. Inflation is like an illness, and the medicine needs to be tailored to the specific problem. Otherwise, you could make things a lot worse. And right now, the Fed has no control over the main drivers of rising prices, but the Fed can slow demand by getting a lot of people fired and making families poorer. And while President Biden is working to increase energy supplies and straighten out supply chain kinks and break up monopolies and bring down prices, you could actually tip this economy into recession. So I just want to say, you know what's worse than high inflation and low unemployment? It's high inflation and a recession with millions of people out of work. And I hope you'll reconsider that as you drive this, before you drive this economy off a cliff. Thank you, Mr. Chairman.
Thank you, Senator Warren. On behalf of Chairman Brown, Senator Tillis, please.
Senator Reid, I'm going to defer and allow Senator Shelby to go before me, and then I'll follow in turn.
Quite all right, sir.
Thank you. Thank you, Mr. Chairman. Chairman Powell, earlier this month, Secretary Yellen acknowledged she was wrong about the risk of inflation. Previously, you also acknowledged that the Fed got it wrong in thinking that inflation would be transitory. Yet myself and other members of this banking committee here have been warning about inflation for over a year. Last July, nearly 1 year ago, when you came before this committee, I raised my concerns about the risk of rising inflation, particularly following the enactment of a $2 trillion spending bill. At that time, there was already evidence that inflation was affecting numerous areas of our economy. I discussed the year-to-year price increases on agricultural goods such as corn, wheat, and soybeans at that time. I pointed out the rising cost of metals, including copper and aluminum. I mentioned the increase in energy prices, used cars, and airline tickets. As someone who remembers, and I do from this committee, encountering high inflation during the 70s, I warned that many of the same conditions present then, such as loose monetary policy and significant government spending, were occurring again, among other things. My main concern last year was that the Federal Reserve would fail to address rising inflation before it was too late. 11 months later, this concern has come to fruition. And as we sit here today, inflation, as you've already pointed out, is at a 40-year high. The average gas price is over $5 a gallon, and we're currently in the midst of 12 consecutive months of inflation above 5%, including spiking to 8.6 last month. Ultimately, Mr. Chairman, as inflation continues to run rampant, I believe the Federal Reserve and this administration failed the American people by not heeding these warnings a year ago and by not acting sooner to address it. We're where we are today, I know that. The consequences of being wrong on inflation are now being felt, has been pointed out here today, by American families and workers across the country. And despite the recent decision to raise interest rates, the Federal Reserve still has a long way to go to get inflation under control. What can we expect in the future from the Federal Reserve? And I know you don't have total control over inflation, but you have a lot of sticks there. And what will you use to bring this under control?
Thank you, Senator. So financial conditions, of course, have tightened and have priced in a string of additional rate increases, and that's appropriate. Well, as you pointed out, and as Senator Tillis pointed out as well, our policy rate is only at 1.6%, but all out the curve, the market is pricing in increases. So financial conditions have already priced in additional rate increases. But we need to go ahead and have them. And I think that the most recent inflation indicators of various kinds suggest to us that we needed to accelerate the pace at which we get up to a level that is neutral, that is close to the longer run neutral level, and then we can make an assessment of how much further and faster to go. And so that's what we're doing. I think you can see from the moves we're making now that we do understand the full scope of the problem, and we're using our tools to address it pretty vigorously now.
Mr. Chairman, explain to us again how important one of your mandates is price stability, how important price stability is to all Americans.
So price stability is really the bedrock of the economy in this sense, in the sense that you really cannot have a sustained period of maximum employment, our other co-equal goal. You can't have that without price stability. And so we must restore price stability, and we will. We have the tools and the resolve and hopefully the judgment to accomplish that task. It's essential that we do.
What's your next step?
Well, if you look at the market has been I think reading our reaction function reasonably well, and I think what you will see is continued progress toward expeditious progress toward higher rates. I'll say this: the center of the committee wrote down that rates would be between 3 and 3.5% by the end of this year, as of a few weeks ago, as of 1 week ago.
Is this Federal Reserve Board of Governors, under your leadership, committed, as Dr. Volcker was some 40 years ago, to bringing inflation under control no matter what?
I would never want to try to compare myself to Paul Volcker in any way, but I will say that we are strongly committed to restoring price stability. We do understand that it is the thing that we need so that we can get back to the kind of labor market that we all want.
But reaching the standard that Volcker left at the Fed would be a high reach, but one that anybody there should try to get there, wouldn't it?
Yes.
Thank you, Mr. Chairman.
Thank you, Senator Shelby. I'll exercise my time now. Mr. Chairman, you point out in your testimony that the core personal consumption expenditures minus gas, food, and rent, 4.9%, and even slightly declined from the previous report. So that leaves the real culprits, gas, food, and rent. First, the issue of gas price inflation is a global phenomenon. Is that correct?
Yes, gas prices are a function of oil prices to a significant extent, and then the refining spread as well.
Right, and that's has been exacerbated by the Ukraine invasion. We've deliberately, and the Europeans have deliberately cut off accessing Russian supplies, and that's added to inflation. And the other problem also with hydrocarbons, it's a cartel that sets the price. Is that accurate?
Sorry, what's a cartel?
It's a cartel that sets the price of oil worldwide.
Yes, globally, that cartel has a very major impact on the price of oil.
And they have decided that further production is not as lucrative to them as just sitting back and making money. That's what it appears like. With respect to food, there are multiple factors there also. One is climate. We've seen loss of arable land. We've seen a lot of factors. All of this is outside the purview of the Federal Reserve, but I think it's helpful to understand what are driving forces in these price increases. Transportation issues with respect to food, that's a function of higher diesel costs, a function of lack of drivers. Again, the Ukraine, a significant amount of wheat is not being exported from Ukraine or from Russia, as well as fertilizers. That's driving the price. And then the rental affordable housing issue, that has been a crisis since I became a congressman in 1990. I recall marching in Washington for affordable housing in 1990. We just don't have enough. And that, I think, is a factor, too. Are those the major causes for these increases in prices?
Those are some of the major ones. You could also point to some parts of the goods economy, which have been restrained capacity. And now you're actually seeing significant price increases in some of the service economy as it really reopens fully now. And that would be the travel and leisure sector.
There's another issue, too. We talked about the cartels that dominate hydrocarbons, but we found, for example, during the pandemic, that there are really just 4 major meat processors in the United States. And with 4, rather than a multiple of that, there is the ability to indirectly restrain supply and increase prices. In fact, some of my colleagues, particularly in the House, have been talking about the antitrust aspects of some of these price increases. Is that a plausible ingredient to the problem, too?
So I think that's really a matter for the competition authorities, not for us. But sure, I think broadly speaking, our economy is very competitive. There will be some industries where that's less so the case.
So these range of you have to take action, and your basically tool is interest rates and going in and out of buying public securities. But we have a lot of work to do, too, which is to try to resolve some of these issues. And we have to do it in order to assist your efforts, the fiscal policy and other policy. I was very pleased to see the president sign legislation with respect to shipping reform. That's a step, but we have to do much more, too. Is that accurate?
I think that's really a question for you. We're very focused on sticking to our knitting and carrying out the task that we've been assigned.
No, I appreciate that, and the independence of the Fed is something that has to be protected by everyone, including particularly yourself. A final sort of issue that I'm thinking of, we're at a tremendous, I think, turning point in our economy. Factors that 10, 15 years ago were not active, things like social media, et cetera. But one other factor with respect to hydrocarbons is perhaps the companies are either unconsciously or consciously limiting investment because they're anticipating an electrified power supply, electric cars, electric everything. Is that something that the Fed is looking at?
I think that is certainly, if you pick up the annual report of any of the big oil companies, you'll see that that is something that is happening, and it's a rational economic response to, you know, expectations about where future policy is headed.
No, I think there are so many factors here, but I think it's good to get some of them on the table. And thank you very much, Mr. Chairman. With that, let me recognize Senator Tillis.
Thank you, Senator Reid. Again, Chair Powell, thank you for being here. By the Fed's own analysis of various policy rules, including the Taylor Rule, the revised Taylor Rule, the Balanced Approach Rule, and the Balanced Approach Shortfall Rule, rates should have begun to rise long before they did. According to the Fed's own analysis of these rules, the Fed's fund rate should currently be above 6%. This is in a report to Congress. Yet the rate currently stands at 1.6%. Likewise, these same rules should have prompted the Fed to begin raising rates Q4 last year, Q1 this year. I'm concerned that the Fed has opted out of rules-based to discretionary monetary policy. As the Fed reviews monetary policy strategy, Chair Powell, will you commit to considering an increased weight for a rules-based strategy in Fed decision-making, and if not, why?
So we do use policy rules like the various forms of the Taylor Rule in all of the analysis that we do. You know, if you're thinking about how monetary policy will affect the economy, you have to have some sort of a rule like that. Fed has never really used them in a prominent way to actually set policy in real time. But that's not to say they don't shed light, and we do consult them. We consult them on an ongoing basis. You know, the rules called for deeply, deeply negative rates during the pandemic, and we didn't do that. They did call, of course, for rates to move up, and rates now really are moving up much closer to where the Taylor Rule, various forms of the Taylor Rule are. And I think by the end of the year, we'll be pretty close to where some of the Taylor Rule iterations are. So it's something that we consider. I think in a couple of years, when we look at our framework again, that's something we could look at.
And Chair Powell, could you just briefly explain the variance between rules-based decision-making being at 6 and where we are today? What other factors came into play?
So what Taylor rules don't take into consideration changes in financial conditions. They just look at the overnight policy rate. As I mentioned earlier, we began signaling, and the way we're set up now to signal policy changes going forward with the summary of economic projections that we do 4 times a year. So markets priced that in, and you're getting a lot of policy tightening well in advance of actually raising rates. As you pointed out, we're at 1.6% only on the federal funds rate, but look out the rate curve. All the very substantial additional rate hikes are already priced in, and they're affecting financial conditions, and they have been for several months. So that's one way of thinking about it. It's really only at the very short end of the curve where rates are still in negative territory from a real perspective. If you look farther out, real rates are positive right across the curve, and that's really what you're trying to achieve with policy in a situation like this, where we have 40-year highs in inflation, and we know we need to have restrictive policy, and that's where we're headed.
Thank you. In 2012, the Fed adopted its current 2% inflation target, then amended this in 2020 to allow inflation to run over 2% target so that inflation averages 2% over time. Many warned this approach would simply give inflation a foothold before the Fed could respond. Now inflation's at 6.5% per year, and many serious analysts are predicting a recession. According to the Fed's framework, will the Fed push inflation below 2% so that it averages 2% over time?
No, that wasn't the way the framework worked. And I should clarify, though, the framework was carefully focused on what we knew, which was the economy of the last 25 years. The pandemic hit a few months afterward, and I think we've been aware since reasonably quickly after that the disinflationary forces of the last quarter century have been replaced, at least temporarily, by a whole different set of forces. And those are the forces that our policy has been reacting and dealing with. And we're well aware of that. I think that what we were looking at was a world in which you didn't see inflation move up even when unemployment was for an extended period well below 4%. This is a different economy, different forces. The real question is, how long will this new set of forces be sustained? And we can't know that. But in the meantime, our job is to find price stability and maximum employment in this new economy.
And final question is, there is some renewed discussions about increased spending and increased taxes through reconciliation. Just hypothetically, if Congress were to pass a bill that increased spending by $500 billion or $1 trillion and raise taxes, would that make your job easier or more difficult?
I swore off getting involved in these fiscal debates a year or so ago, and I'm determined to see if I can't stick to that. But remember, we can always incorporate. And what we do is we take fiscal policy as given, and we react appropriately.
Well, then maybe instead of policy working through Congress, but policy that was passed by Congress, do you believe that the $1.9 trillion spending package last year had any effect on inflation?
This is really not our job to pass judgment. We didn't pass judgment on the Tax Cuts and Jobs Act or the CARES Act or that act as well, the ARP. So I really think that's a job for Congressional Budget Office.
Thank you, Chairman Powell.
Thank you, Senator.
Senator Cortez Masto of Nevada is recognized for 5 minutes.
Thank you, Mr. Chairman. Chairman Powell, thank you for being here. Let me start with high prices. Because not only in Nevada, but across the country, we're seeing high food, housing, and gas prices, which really is creating a financial hardship for too many families. And I want to start with gas prices first. In Nevada, average price of gas is $5.60. In Las Vegas, about $5.60. In Reno, at $6 a gallon. And as gas prices rise across the country, oil and gas companies, we know, are making record profits, but are using that money to continue to consolidate their industry and pay for stock buybacks instead of investing in increased oil production. On one of them, and one I've heard, is over 9,000 permits that they have that are unused drilling permits, or they're not expanding their refining capacity. We also know that reduced refining capacity is a particular problem that has been caused in large part by decades of oil industry consolidation and is driving gas price hikes to be as much as 61 cents a gallon higher than expected. So when considering the drivers of inflation, how much do Federal Reserve economists consider consolidation in an industry? And what else can we do to hold these industries accountable for their contributions to rising prices?
So those are really questions for the competition authorities, questions of industry structure and consolidation. They really aren't questions that we directly address. We raise interest rates, and our job is maximum employment.
But I have to push back. You have to consider that. I mean, you're considering what's happening in Ukraine as a variable on inflation and high prices. So you have to consider the fact that we have these oil companies. They are exclusively control this commodity that is key for this country. We know that not only do they produce and decide how and when they're going to drill crude oil, we also know the refineries, and quite honestly, the refineries in this country are not prepared to refine the domestic oil that even comes from Texas and the Dakotas. The refineries are prepared to refine the oil that comes from out of this country. And we also know that many of the oil companies have their own traders that are trading on the price of crude oil in this country. I mean, listen, you just talked about an outside agency. This is why this is so important and why I am a co-sponsor of the Transportation Fuel Market Transparency Act. Glencore was just fined $1.1 billion because they were manipulating the oil prices to their benefit. So that is something you have to take into consideration when we have an industry like these gas and oil companies that are so consolidated. They are having an impact on the prices to the detriment of the people in my state. So that has to be something you consider and take into consideration when you're looking at the impact that people across the country are seeing from these high prices. I hope it is. Please tell me you are.
Well, I think we see that the global oil prices, which have very important effects on gas prices here at home, are set on the global market, and that, as we mentioned earlier, there's a large cartel that is responsible to a significant extent for setting those prices. We take that as given.
So do you pay attention to what Wall Street is saying and what these cartels are doing? When you say cartels, these are these big oil companies, and they're indicating that, well, I'm not going to drill because I'm making profits because the price of gas is so high. So you would assume, I would hope that you would take that into consideration, that it's going to continue these high prices because there is a challenge in holding these oil companies accountable.
So in principle, we pay attention to anything that could affect the use of our tools and the need to use our tools. And I think with the future price of oil, the best thing you can probably do is look at oil futures, because that futures in theory should be taking into account all of these factors, and that's what we do. But ultimately, the question for us is, do we raise or lower interest rates? We don't have tools that would address these practices that you're discussing. They're not really, of course, we understand them.
Well, do you have concerns that these oil companies are manipulating or controlling the prices that we have right now? Do you take that into consideration with the tools that you need to reduce inflation and reduce these costs?
Honestly, those are not judgments for us to make. The questions about industry structure and competition are really not, it's not our assignment. Our assignment is employment and price stability.
The outcome of that infrastructure is something you've got to take into consideration.
Yes, very
Unless
much.
they change, the prices are not coming down. Unless they stop giving profits and sharing that with their shareholders and start addressing and looking at actually the consumer at the other end of this, who is bearing the brunt of it, these prices are not going to come down. I would assume you take that into consideration. Maybe I'm wrong.
Well, when you say take it into consideration, we do have to have a forecast of oil prices, and we do. But ultimately, though, the question for us is price inflation. What's happening with price inflation? And it's a macroeconomic question. It's not a question about industry structure or corporate behavior. It's a question about what will be the behavior of inflation across the economy. And in particular, there's really not anything that we can do about oil prices. There's a little, food prices is a bit more mixed, but for oil prices, they're set at the global level. It has to do with global oil prices and also the refining spread. Neither of these are things that we have the tools to affect.
Does it concern you that these oil companies haven't come to the table to look for a solution to help us reduce fuel costs?
I don't think it's appropriate for the Fed or for me to be reaching out into areas of policy that are not assigned to us. It's not up to us to comment on that sort of thing. We have a very specific job and precious independence to carry that job out. And I think the other side of that is stick to that job. And our job is maximum employment and price stability.
Thank you, Mr. Chair. My time is up.
Thanks, Senator Cortez Masto. Senator Rounds from South Dakota is recognized.
Thank you, Mr. Chairman. Chairman Powell, welcome again. It seems as though for the last couple of times that we've had you in front of this committee, inflation has been a primary item of discussion. I want to follow up just as my colleagues have, and I'd like to take it in a little bit different path, perhaps, because when it comes to breaking down the different causes of inflation, clearly there is the supply side and the demand side. And the reality is that a large portion of the inflation stems from the higher energy prices, which is part of the supply side issue. When President Biden took office, January of 2021 through January of 2022, the price of unleaded gas has increased by 50% during that time period, from $2.33 to about $3.30 per gallon. Now, that was well before the Russian invasion of Ukraine. Higher prices are instead, I believe, a direct result of policy decisions made by the Biden administration, like prohibiting new oil and gas leases on public lands and waters and choking off future access through the Keystone XL pipeline and increasing U.S. dependence on foreign energy sources by actively calling on OPEC to produce more oil. All of these seem to send a terrible message to the market about the future of investing in oil and gas processes within the United States. At the same time, Mr. Chairman, your tools are designed, as we've discussed in the past, to impact not necessarily the supply side, but the demand side of inflation. So if you attempt to use your tools that are available at this time to address what I believe to be the policy-induced side of inflation, do you risk hurting the economy by using these interest rate increases when, in effect, as you've indicated earlier here in this meeting, that you really can't impact the price of gas or the price of food?
So I think that's right. We know that our tools can affect certain aspects of inflation, and that would include certainly energy inflation and food inflation. So nonetheless, our statutory goal is headline inflation. But we also know that core inflation is actually a better indicator of headline inflation than headline inflation itself is, because food and energy tend to be quite volatile. They tend to move up and move down, and that's been the history. So core enables us to look through that volatility, and so we focus very much on that as a better representation of what underlying inflation of the economy is at any given time.
And I think but in this particular case, that core inflation, if we're not going to include some of those, what I think earlier we thought would be transitory in nature portions of inflation, they have proven not to be transitory. In fact, South Dakotans are now paying $682 more per month on goods and services than they were when President Biden took office due to inflation. The administration is claiming the Federal Reserve can fix our inflation problem. But as you just indicated, you focus on core, and your tools might very well work on core, but not on those really heavy drivers to inflation that South Dakotans are seeing like the rest of the country. See, Mr. Chairman, what I believe is going to happen here, and I just share this, clearly you are aware that you're going to be the person that takes the fall if inflation is not brought under control. And this administration is going to point to you and to the Federal Reserve saying, you have the tools to fix inflation and you're not doing your job. When in essence, the portion of inflation which Americans are feeling today may not just be the core inflation that some of your tools do, but the total cost of inflation that my citizens in South Dakota feel to the tune of, well, $682 more per month in living expenses than what they were when this administration took office.
So we're focused on the part of it that we can address, and that is there's a job to do on demand here. There are parts of the economy where demand exceeds supply, and that's where we think our tools can help, and that's what we're focused on.
Very good. Just very briefly, Mr. Chairman, another item. The Basel Committee on Banking Supervision issued a press release indicating that it had made substantive technical changes to the calculation of the GSIB score for EU-based global systemically important banks, the GSIBs. Do you, the Federal Reserve as being a part of this organization, do you believe right now that this change reflects the views of the Federal Reserve as an influential member of the Basel Committee? Apparently, it looks like this may very well provide some advantages to our European banks over U.S. banks based upon this reassessment of how they view risk within the EU community.
So my understanding of that is that it's really about supervisors being able to use discretion about transactions that go across national lines within the European Union.
Yeah.
It doesn't apply at all here. And ultimately, the capital rules that Europeans apply are decided by Europeans, not by us.
Very good. Thank you, Mr. Chairman.
Thanks, Senator Rounds. Senator Warner from Virginia is recognized.
Thank you, Mr. Chairman. And Chairman Powell, it's good to see you again. Thank you for your your service to our country. I want to go a couple of different directions. First, and I think some colleagues have already raised this, but the truth is what we're grappling with right now on inflation is clearly a global phenomenon. I think even the Cato Institute group that doesn't always necessarily agree with folks on my sides of the aisle have pointed out inflation in many industrial countries around the world is running at the same rates, if not higher than us. I frankly just returned from a bipartisan trip to Finland, Latvia, and Turkey, getting back late last night. I'm still a little bit jet lagged. And Turkey, I think inflation's running at 78% a year. Finland gas prices were at $9 a gallon, and I asked one of my dear Republican colleagues, you know, it's amazing. Joe Biden's inflation hitting here in Finland too. The point being that a lot of these effects are not due to any single country's activities, but it is a global effect. I think colleagues have already acknowledged the effect that the Russia-Ukraine war has, some of the disruption on supply chains. What I don't think has been fully addressed yet is
connection lost.
Some of the challenges that are coming around from China in terms of their zero COVID policy, a lockdown on Shanghai for literally months on end, and how that supply chain disruption is floating through the whole global economy. Can you speak to that, Mr. Chairman?
Sure. So, of course, you're right. Inflation is very much a global phenomenon. If you look at comparable large advanced economies like ours, you'll see inflation rates that are quite similar to ours, in some cases higher, some cases lower. But there are important differences in the characteristics of that inflation. Ours is more about demand, I would say, than most of the others. And theirs is more about energy prices and things like that. In terms of your question on China, we don't think we've seen the full effect of the lockdowns that we've had, but we'll expect to be seeing some negative effects on bottlenecks. On the other hand, China now seems to be coming out of that period of lockdown, and growth seems to be picking up. Advanced indicators are that their economy may be recovering, but of course, the zero COVID policy, as long as it's in place, it certainly could. You could certainly have a relapse given this highly contagious disease.
Let me and again, we're all looking for short-term items, and frankly, I'm glad that the president, I know particularly some folks on my side of the aisle are concerned about the president visiting Saudi Arabia and visiting with the leadership of that regime. I think you've got to use all the tools in the toolkit, and getting additional partners in the middle, or players in the Middle East to increase oil production, I think is important. I'm a little less, I got a lot more proof to see whether some kind of short-term gas tax holiday would actually provide relief to consumers, or simply, as we've seen in some states that have implemented it, the prices don't change and the companies may make more money, but it doesn't provide that kind of inflationary relief. And I am concerned, as somebody who spent a long time as governor and as senator trying to make sure we pay for our infrastructure investments. Easy to take away a tax, tough to put it back on, and there's always an excuse not to, but I'm open to seeing a better analysis. I do want to raise, in recognizing that not everything can be done with a flick of the switch. You know, there's a piece of legislation that has been floating around here for almost a year, passed the Senate a year ago on a broadly bipartisan basis, passed the House a number of months ago. I think the House, frankly, took the wrong approach. But it goes at least one of the inflationary pressures here, which is making sure that we've got a domestic supply chain on semiconductor chips. Every device that has an on and off switch requires a semiconductor chip. And right now we see, particularly around auto inflation, one of the big drivers is the lack of chip supply, so cars can't actually be sold. They're literally sitting warehouse waiting for the semiconductors to come around. This legislation, $52 billion of investment, would build at least 10 semiconductor facilities here in America. I know Senator Brown has been a big advocate of this. If we don't do this, I don't think there'll be another semiconductor facility built in America, even though some have been announced. I point out the fact that, you know, a year ago, the Europeans had no plan here in semiconductor investment. Intel recently announced $8 billion from the German government. When the German bureaucracy and European bureaucracy moves faster than the American legislative process, I don't care which side of the aisle we're on, we're in trouble. So in the last few seconds, I know you don't want to weigh in on a specific piece of legislation, but the notion of investment in a key industry component like semiconductors, long-term in terms of keeping inflationary pressures down, Right move or not?
Again, I wouldn't, as you say, I wouldn't comment on a specific legislative proposal.
Talk about the industry
I'll
sector.
just say that I do think we learned a lot about global supply chains, and we're still learning, and it's important to take the right lessons, and I think it's an important area to explore about how we can harden up and improve our sourcing capabilities, including what should be here.
Thank you, Mr. Chairman.
Thanks, Senator Warner. Senator Kennedy from Louisiana is recognized.
Mr. Chairman, inflation is just an imbalance of supply and demand. Can we agree on that?
Yes, generally.
And to put a little finer point on it, our inflation at this time, and this is the case with respect to most cases of inflation, demand is greater than supply, so prices go up.
In some parts of the economy, yes.
Right. Now, you're trying to lower, so we've got a situation where demand's up here, supply's down here. You're trying to lower demand. Is that correct?
Yes, while also giving the supply side time to recover. There's some ground to be covered on that side.
Yes, but you've talked about your role, scope, and mission, and your job is monetary, and you're trying to lower demand.
Well, I'm trying to I would say lower demand growth. We don't know that the demand has to actually go down, which would be a recession.
Well, 70% of our economy is driven by consumer demand, and you're trying to lower demand and slow the economy down. Am I correct?
I guess I'd just say we're slowing down growth.
Right. That's what the economy is. Growth.
Yeah,
okay.
Exactly.
All right. There's another way. The two aren't exclusive. You alluded to that. You can also lower demand, but you can increase supply. Can you not?
Yes.
And that would solve inflation.
Yes, it would.
Now, Congress's job is not to deal with demand per se. A lot of the bills we pass impact demand, but that's the Fed's job.
Right.
Okay? Now, I'm not going to ask you to comment on any specific bill, but tell me the things that Congress could do right now while you're lowering demand, not you literally, the Federal Reserve, what we can do right now to increase supply.
I think the things you can do are important over the medium and longer term, but probably not so much in the short term. But it's things that like investing in people so that they can remain in the labor market longer, things like that, and infrastructure, things that will increase the productive capacity.
Well, how about in the long run, as Keynes said, we're all dead. I'm interested right now in the short run. What about if we reduce the regulatory burden, let's say on refineries, wouldn't that incent refineries to start refining more and help on the supply side?
I would say anything that could increase capacity on that front could have.
Yeah, but would that help? I'm not trying to get you to endorse legislation. Look, Mr. Chairman, we got a hell of a mess here. Okay, inflation is hitting my people so hard they're coughing up bones. I don't care what the inflation is in other parts of the country, of the world. I'm sorry they're having inflation in other parts of the world, but them in misery doesn't make my people feel better. They're still miserable. Inflation is hitting people so hard they're coughing up bones. It's the highest in 40 years. Our national debt is greater than our national output. Crime's up, the border's open, respect for institutions is way down, and 70% of the American people think we're headed in the wrong direction. Now, we got a hell of a mess. And right now, you're the most powerful man in the United States, maybe in the world. We've got to get, President Biden, I don't blame him. I understand politics. He keeps saying, well, your 401k has crashed and gas has gone from $2 to $5 a gallon because the economy's so good. And the American people know that's not true. Now, other than relieving regulatory burden, well, let me put it in the form of a question. What if the United States Congress said, look, we've got a budget. We're going to freeze spending. We're going to stop injecting more money into the economy. We're going to freeze spending until Powell can get control on the demand side. Would that help?
You know, I feel like giving you advice on what to do when
I'm asking
we're
for
not
it.
getting
I welcome
we're not getting our own job done. I feel like maybe a better thing to do would be for us to get our house in order and do the job you've assigned us.
Well, let me put it another way. Let's suppose, forget about Congress. Let's suppose that every governor in every state and every legislature in every state got together tomorrow and said, I know it's not likely to happen, and said, we are going to freeze our budgets. We're not going to spend a penny more than's already budgeted. Would that help?
Would it help?
Sir?
Would it help with?
Would it help reduce inflation?
It would depend on it might, but I mean it would take. Again, I'm giving you. I'm scoring fiscal policy.
Well, I understand
really
you're being careful, but Mr. Chairman, the United States Congress, in addition to its regular budget, has spent $7 trillion. I'm not saying all of it was unnecessary. On top of that, the Fed's increased its balance sheet from $1.5 trillion to $9 trillion. $9 trillion. I know you're cutting it back, but we've injected all of this money into the economy, and then people go, well, we have inflation. Duh. Give me some help here. Tell me what we can do.
I'm really focused on what we can do, which is shrink our balance sheet and raise interest rates and get supply and demand back into alignment and get inflation back down to 2%.
Thank you, Senator Kennedy. Senator Tester from Montana is recognized for 5 minutes.
I want to thank the chair and ranking member. I also want to thank you for being here, Mr. Chairman. I appreciate it. I've just got to say one thing about Senator Kennedy. I think freezing spending is probably a really good idea, except we just had a flood that cost $1 billion worth of damage in southern Montana. $1 billion worth projected. We freeze spending, that infrastructure never gets rebuilt. So I hear what you're saying, and in some aspects I agree, but it's a lot easier to talk about than it is to do. And I think that's the challenge that the chairman of the Fed has, is that he really needs to focus on what he needs to do. And if it was a simple solution, we'd already had it done. I'm concerned about rural America and the impact inflation's having on rural America. And I know that you have seen it. You've seen it transpire over the last several years, particularly as this country's come out of this pandemic. And I know we've had a conversation that it's two-edged, it's supply and it's demand, and you're only dealing with the demand part, which is an important part. And in some respects, Senator Kennedy's right. You are probably one of the strongest people in the world to be able to deal with some of this stuff. But from a rural perspective, is the Fed doing anything in particular that I could take back to my constituents and say, this is what the Fed's doing to help rein in inflation in rural areas?
Well, so we are, of course, well aware. As you know, we have 4 or 5 Reserve Bank presidents who have very large agricultural economies within their districts, and we hear, excellent reports from them about what's going on, and it's clearly a tremendously challenging situation. Fertilizer prices and all kinds of inputs, very, very difficult situation. Can't get parts for your equipment and that kind of thing. So, overall, we do appreciate that. You're not seeing this yet, but when if times do get difficult, then we work carefully with borrowers in the Farm Belt and that kind of thing, because we know, that's what you do in those kind of times. We're not at that times at this point, but that's one thing we have done in the past. I mean, overall, we think we need to get back to price stability, and that will help. That will help everybody. It will help the whole economy, including rural America.
Okay, interest rates. I know they've been raised a bit recently. I think 3/4 point. Correct me if I'm wrong. And I'm not going to ask you where interest rates need to be, but I do think that there's a fine line to walk, and you tell me if I'm wrong, where if interest rates are raised too high, it could drive us into a recession. Can you tell me some of the things you're looking at to make sure that doesn't happen?
Sure. So when we pivoted and started talking about raising rates last year, markets have priced in rate increases so that all out of the curve of debt maturities, interest rates have already moved up to reflect interest rate increases that we haven't actually made yet to our. So what we have right now is a low short-term rate, which is our policy rate. So, and the increase that we made one decision at the last meeting, which was to raise by 75 basis points, but only to 1.6%. So, and we thought that was the right thing to do. I'm happy to discuss why. But really, the point is that our policy rate is still at a relatively low level. And in principle, we want to get it up to a more neutral-ish level, even more expeditiously than we had been. And that's what was behind our thinking. And that's really, so the concern, I don't think is about the level, it was with the speed. Are we moving too quickly? And I think I was persuaded that it was important that we make this move now and not wait and telegraph it and do it 6 weeks later, for example, or the meeting after that. It was important to do it now because where we are with inflation is having seen inflation come in above target over and over again. And we said we'd move more aggressively if it was appropriate. We thought it was appropriate, and we did.
So what? And so you said you want to get the things more to a neutral level, and are we to a neutral level now?
No, so we estimate the longer run neutral level of the federal funds rate to be in around 2.5%. And actually, we think it will be appropriate to raise rates above a neutral level into a modestly restrictive level, because this is very high inflation and it's hurting everybody, and we need to do our job and get inflation back on a path down to 2%. And the way we're going to do that, we think, is raise rates, of course, to that level. Of course, everything depends on the data that we see. We're really strongly committed to getting inflation down to 2%, but we're going to be flexible as we see the data coming in.
Do you agree with the perspective, and then I'll be done, but do you agree with the perspective that if interest rates go too high, too fast, it could drive us into a recession?
It's certainly a possibility. It's not our intended outcome at all, but it's certainly a possibility. And frankly, the events of the last few months around the world have made it more difficult for us to achieve what we want, which is 2% inflation and still a strong labor market.
Yeah. Thank you, Mr. Chairman.
Senator Haggerty of Tennessee is recognized.
Thank you, Chairman Brown. Chairman Powell, one of the many downsides of quantitative easing is the fact that the Federal Reserve, and then by extension the American taxpayer, is essentially taking a long position in the securities that are acquired. And that means that when rates rise, the value of the securities on your balance sheet drop. That's exactly what's happening today. And as of March of this year, the Federal Reserve had about $330 billion worth of unrealized loss on its balance sheet. That number's probably close to $500 billion right now, given the rise in rates. So my question of you is, do these unrealized losses limit the Federal Reserve's ability to execute its monetary policy objectives? And specifically, will the Fed sell mortgage-backed securities and realize a loss? Or will the Fed be cornered into holding these securities until they appreciate?
So those kind of unrealized losses play no role in our decision-making, have no effect at all on our ability to conduct monetary policy. They're just not a consideration. And they won't be a consideration when we decide whether to sell and in what quantity MBS. We said we would look at selling MBS when the normalization process for the balance sheet was well underway. And that means not soon. We haven't decided exactly what that means. When we make that decision, and the reason, by the way, the reason we want to do that is we're committed to having a mostly Treasury balance sheet. And with these higher rates, MBS prepayment speeds have gone way down. And so to achieve the mostly Treasury balance sheet, we may well need to sell MBS at some future date. When we turn to that, we're going to be very transparent and give lots of transparency, obviously, but we won't be thinking about the balance sheet. I mean, remember that we've contributed $1 trillion in profits to the Treasury over the course of the last 10 years. The reason we don't have a lot of capital is that we give our earnings to the Treasury every year. So it's not at all a concern for us.
But to be clear, these long-dated mortgage-backed securities may be sold as a loss. You're not limiting your ability to do that, to sell at a loss.
No.
And that could happen. I just think that the downside of quantitative easing is very much illustrated for us when you find yourself in this situation of holding these long-dated securities. To turn to another point, Chairman Powell, I realize there are a number of factors that play a role in the historic inflation that we're experiencing. Supply chain disruptions, regulations that constrain supply. We've got rising inflation expectations and excessive fiscal spending. But the problem hasn't sprung out of nowhere. And in January of 2021, inflation was at 1.4%. By December of 2021, it had risen to 7%, a five-fold increase. Now, since the war in Ukraine began in late February, the rate of inflation has risen incrementally, another 1.6%, to a current level of 8.6%. So again, from 7% to 8.6%. Given how inflation has escalated over the past 18 months, would you say that the war in Ukraine is the primary driver of inflation in America?
No, inflation was high before, certainly before the war in Ukraine broke out.
I'm glad to hear you say that. The Biden administration seems to be intent on deflecting blame, and as recently as just this past Sunday, spread the misinformation that Putin's invasion of Ukraine is the, quote, biggest single driver of inflation. I'm glad you agree with me that that is not the truth. I'd like to turn to the situation we find ourselves in now, tightening. A recent survey of global CEOs showed that more than 60% of executives expect a recession in the next 18 months. Meanwhile, per its most recent forecast, the Fed will be tightening monetary policy for the next 2.5 years. Thus, the Fed could soon find itself in the challenging position of potentially exacerbating an economic downturn in order to address the historic inflation that's been unleashed by the Biden administration. So, Mr. Chairman, as you know, the Fed has a dual mandate, stable prices and maximum employment. As we look to the fall, how do you think about balancing this potential tension between the Fed's two mandates, particularly if the economic outlook worsens, but inflation remains elevated?
So we do have a dual mandate, as you point out. Right now, the labor market is extremely tight and I would say unsustainably hot. There's a mismatch between supply and demand there. As you know, there's more job openings than there are, by a factor of 2 to 1, than there are unemployed people looking for work. On the inflation side, we're very far from our target. So we think that we have to restore price stability to put the economy back in a place where in the medium and longer term, we can have a sustained period of what we would call maximum employment. So that's how we're thinking about it. Of course, we're not trying to provoke and don't think that we will need to provoke a recession, but we do think it's absolutely essential that we restore price stability really for the benefit of the labor market as much as anything else.
I agree. I think you have an extremely challenging job, particularly given some of the fiscal policies that have been undertaken that make your job more challenging than it should be. Thank you very much, Mr. Chairman. Thank you.
Thanks, Senator. Senator Smith from Minnesota is recognized for 5 minutes.
Thank you, Mr. Chair, and welcome back to the committee. Chair Powell, it's good to see you again. I want to follow up on